Good afternoon, everyone. Wish you warm welcome to our Specialized Investment Fund Common Derivative Examination Training Workshop. Am I audible to you?
Yes.
Okay, thank you very much. Okay, so let's start the journey. So first question in our mind, why this examination? You know that there is a one product which is expected to come in next 1 or 2 months, specialized investment fund, okay, which is the, you can say, one of the upgraded version of the current mutual fund with the some innovative strategy. We'll discuss in detail. So why this examination? As per SEBI circular, must to pass the exam NISM 13 common derivative certification for MFD to sell the upcoming SI product. So one of the important or most important reason why we are conducting this training to learn the content of the exam, and we get the required competence with help of the post-training preparation, and we pass the exam. So when this product is launched, okay, so you are basically prepared to discuss with the client and convert the client for the upcoming new product. So I'm sure that you must have some idea. So may I know what is the minimum ticket size you require for this product? I request you can write it in a chat box so everyone can participate. Okay, good, quick answers. So there are people are learning. So minimum ticket size is 10 lakh rupees. In mutual fund, we know that it is a minimum when NFO comes, it is a 5,000. So it is very important that key SEBI wants you prepared with the additional knowledge and skill set to understand when product is launched and better prepared to discuss with the client. Okay, so now I am building the brief to the you because I know that right now most of our partners, okay, and some of maybe our prudent employee. So I am discussing to give you a macro perspective why you should attend the training attentively, complete the required post-training preparation and pass the exam, because I am giving you idea what are the key benefits to you, okay. So first and foremost key benefit is a new concept, new product. Okay, the new product is expected in next 1 or 2 months. So a lot of excitement in the investor, because I'm sure that you must be watching the television or business channel. So there are recurring regular discussion among the people who come and talk about the features and benefit about new product. So investors are aware and they are excited to what is new product, because after long period, I think that key AIF was launched in 2013 in India, but it was for a 1 crore ticket size. Okay, so I'm sure that key after 10-15 years there is a one product coming with starting ticket size of 10 lakh. So it can attract a lot of upper middle class client. And we'll discuss during this journey. So there is a high potential for the alpha generation using the derivative strategy. So that's the reason we are learning. So compared to the our regular mutual fund product, it is expected that key long short strategy, okay, is expected to deliver a higher risk and higher potential return, higher alpha. Now for you, one of the biggest advantage is expected to be a lower competition for a sizable period, because derivative is one of the difficult subject to be considered even in the professional exam like CFA, MBA finance. So in CFA, there are 10 subjects in each level. And if you ask anyone who is pursuing CFA certification, which is one of the most difficult subject, and you will likely to get the derivative 1 or 2 rank in terms of difficulty. Okay, so right now I can say that even in next 6 months, less than 5% existing distributor or existing MFD is expected to complete the examination, because chances that they may not lucky enough like you, where we have a internal qualified and experienced faculty who can conduct the training and provide the regular support to ensure the you pass the examination with good knowledge and skill set. So okay, we introduced in March, April for PMS examination. And right now, I'm happy to share that almost 100 plus partners, those who attended our training and completed post-training preparation, completed their PMS examination in last 3-month period. And I'm sure that this is expected in SIF product also. Definitely compared to PMS, difficulty level is higher. So you require more time and investment. Domain expertise will help you to educate the benefit of long-short equity fund to potential or existing investor, which leads to higher conversion rate, opportunity to build good AUM, maybe 5 to 10 crore AUM in next 1 year period for you. So this is the macro I am sharing you idea that these are the expected benefit those who attend attentively and complete the post-training preparation and complete the examination in next 1 month period or maybe 1.5 month period is likely to benefit with lower competition, early bird opportunity, and the opportunity to connect with the potential or existing upper middle class client and build the good AUM. So for that, what we require? So to pass the examination, you require a focus on building the domain expertise. So our focus is on learning, and byproduct is the basically passing the exam. So higher the competence and the confidence lead to a better client conversation. Okay, conversion and higher SIF AUM. We know that relationship is important. So relationship can give you an appointment, but qualitative discussion and valuation leads to a client conversion. So let me just conclude the initial part, and I'll ask your question. If you have, you can write in a chat box. So how to pass the exam at first attempt? So right now, 83 odd participants are with us. So it is very important that you attend attentively this online training, because if you do a multitasking, okay, chances that you missed out the important concept. Okay, and then it is very difficult again to discuss during this training. So that's the reason we are recording the content, this training, and we'll upload on our partner desk in the next week. Okay, so I request to have a attentive learning. You can keep your camera on. Okay, if it is convenient to you. So when your camera is on, it will be a qualitative and attentive learning. This is technical training, and again we are doing online training. So it is quite difficult for me to have a control, because if you are sitting in a classroom environment in physical training, okay, then definitely I can have a control. Okay, like I can ask you to not to pick up your phone. Okay, keep your attention here. Okay, don't discuss. Okay. But here in online training, there is a limited control with me, or practically I can say nil control with me. So it is very important. It is your duty to keep yourself interested and engaged. You need to prepare your notes during this training. Enjoy your new learning, because there is a thought process in mind that I am spending my 20 hours time. Okay, then another maybe 40, 50 hours for post-training preparation. Gods know when result will come. Okay. And I'll get the benefit. So if you think that and if you focus on today's outcome, chances that you may not able to excel in your professional career. So to excel in the professional career, you have to think like a farmer. So farmer, even poor farmer, okay, when basically does a farming. Okay, it takes average maybe a 1 month to 3 months or sometimes 6 months to get a crop ready. Okay, so it is like a farming where you invest your time. Okay, maybe 20 hours for training, another 50 hours for post training preparation, and that's how in the next 1 year you will be able to build a additional AUM of maybe 5 to 10 crore. Okay, with help of the SI product, and you have a edge against the competition. So you need to participate, ask question, attend sincerely pre-training test and post-training test. Okay, this training will give you a strong foundation to better prepare for the exam. So in 20 years, it is not expected that you are going to be expert. Okay, so even if you get 50% understanding, it is quite good. It is like a strong foundation, and remaining 50% you will get when you complete your post-training preparation. Okay, then you will achieve this 100%. So it is not expectation that during this training I get 100% and then I just go to exam and pass the exam. So it is not like a basic examination, okay, where you can go and write the examination. So that's the reason I am giving you clarity and giving you a thought process. You need to invest good amount of time during this training and the post training, so you are get required competence and pass the examination. So I request, if you have any queries, okay, right now what we have discussed, you can either write in a chat box, okay, or you can unmute and ask the question, because I want a qualitative participation is also required, relevant participation, not something which is not discussed. So this question should be based on the what we have discussed in last 10 minutes. Okay, so we'll discuss about the post training in upcoming passing criteria. Also, we'll discuss in coming session. Okay, during this journey only today. But in this 4 slide, if you have any specific query, okay, why examination, what are the key benefit to you, how to pass at first attempt, and the my expectation from your side. We'll discuss. There is no need to worry. We'll discuss examination criteria. So hopefully I understand that you got a clarity, okay, about the importance of the exam. I'll take 2 minutes because some participants maybe join a little bit later. So I'm just giving you quick thought process. This examination is mandated by SEBI to sell the upcoming SI product, and SI product, which is one of the new product having the ticket size of 10 lakh rupees, okay, and has a potential to generate the higher expected return than the mutual fund, traditional mutual fund using the derivative strategy. Okay, why you should focus on this training and examination? Because it will have a lower competition, early bird opportunity, okay, and you will be able to add the good AUM in next 6 to 12 months. Again, to pass this examination, you need to attend this training attentively to keep yourself interested and engaged. Okay, prepare your notes, participate, ask question, and training will give you a 50% right now strong foundation, and balance 50% you get with the your post training preparation. Okay, so I'll just quickly go ahead. I'm not going right now complete detail, but specialized investment fund is like a long short category. Okay, I'm sure you have registered with the training, so I'm sure you must have read the content. There is a up to 25% short selling is allowed. So what is a short selling? Short selling is basically selling the stock or index without holding it. Okay, so that is called long short fund. So target savvy investor HNI with more focus than MF. Okay. Minimum ticket size we have already discussed, 10 lakh rupees. Again, SIF may have a open-ended or close-ended or interval-based, depend on the AMC. We'll come to know when product will come. Now holding mode, physical or demat. Okay. So focuses on narrower set of category. Right now, this is the categories introduced by the SEBI. So this is a SEBI circular, and as per a SEBI circular, so there is a one called equity long short category. Again in long short, X top 100. So it is like a mid and small cap. Okay, it is a first is like a multi cap because it is only equity. So include the top 500, X 100. Then sector rotation fund is there. So there are flexibilities given in SIF. Once you go through it, the product when it is launched compared to the mutual fund. So as I said, it's allow the short selling up to 25% of the net asset apart from the hedging. Right now, we can say that most likely the tax treatment will be same like the mutual fund, but clarity yet to come. For SIF, NISM derivative examination is required. So now quickly go through the NISM 13 examination objective. So on successful completion of this, candidate should know the basics of the Indian derivative market covering equity derivatives, currency derivatives, interest rate derivatives, understand the various trading and hedging strategies that can be built using the future and options, understand the clearing and settlement, risk management, as well as the operational mechanism related to the derivative markets, know the regulatory environment in which derivative markets operate in India. Okay, so this is the assessment structure. Someone asked the question. Okay, so number of question is 150, number of marks is 150. So it is like a equal mark, equal weight. We can say each question 1 mark. Example, 3-year examination pass percentage is 60%, negative marking is 25%. So if you want to pass at first attempt, it is expected that you write 102 questions right, okay, correctly. And if 48 answers wrong, so 25% of 48 is 12. So you got the 90 marks. So it is expected that to get the 102 out of, you can say 150, approximately you require a 65% right answers. Okay. So that's the reason very important that without knowledge and skill set, it is quite difficult to pass the exam. Exam fee is 3,000. You can carry calculator or use the Excel sheet. You can carry a blank paper and do a rough work if you require. I'll just quickly show you the first syllabus. So this is as per the NISM book, there are 10 chapters in the equity derivatives, another 10 chapters in the interest rate derivatives, another 10 chapters in the currency derivatives. So total, we can say 30 chapters, 3 examination NISM conduct, and due to this regulation, okay, they have introduced the new exam starting from April this year, which is a NISM 13, which covers all 3 examination syllabus. Okay, let me just complete and then I'll take some of your question. Okay, some questions are there. So let me just. So questions will be offered only through agent or directly AMC like direct mutual fund. Right now product is not launched. So once product is launched, we'll come to know. Okay, wait for clarity. Calculator you can use either normal calculator, or if you don't want to use the Excel sheet, you can use Casio FC200V or Texas HP, which is a financial calculator. Okay, which is used in professional examination like CFA, CAP, where you don't require need of Excel sheet. Okay, now I'll come to know the next important part. Okay, so one point of time when you go through the syllabus, 10 chapters in equity, 10 chapters in interest rate derivatives, 10 chapters in currency derivatives, approximately 250 pages in each book, so 750 pages approximately. But with help of my expertise and my experience, I have divided study plan for your benefit. So if we go by book, okay, we may require maybe a 50 to 60 hours of training, but that kind of time we don't have, okay, because we are professionals, okay. So I have tried to complete in a 20 hours where I can cover the core syllabus, okay, maybe 75%, and you create a foundation, okay, and then balance 25% you can do in a self study. Self syllabus, broadly we can say 3 exam, 80% is common across the exam. We broadly divide into 3 category. 40% is theory, 40% is calculation, and 20% is information questions. Okay, so when we conduct pre-training and post-training test, you will come to know, okay, what kind of the question you may get, and what are the theory questions, concept questions, what could be a calculation questions, what could be the information question. Okay, your focus not only pass the exam but upgrade your skill set and pass the exam. Because please understand, when someone asks about the direct versus the regular plan, okay, so in that condition, okay, so what is your value addition? So if you just think like a mutual fund where you suggest a 5,000 rupees example lump sum, or maybe 1,000 rupees SIP, okay, where value addition is limited, where here you require a lot of value addition to educate about the how this product works, how derivatives can play the role for the alpha generation, okay, because AMC and investor have a minimal intervention or discussion, or even a discussion is through the maybe a television channel or maybe investor vessel program. But here you are the bridge between the investor and the AMC. So you are the bridge between the product and investor. So chances that the investor is expected to ask most of things from you only about their queries, questions. So if you are prepared to solve their 80-90% of query, then definitely they will prefer to go with the you only. So that's the reason you require, based on your background, if you have a strong background, okay, maybe you require 40 hours of preparation. If you are a fresher learning derivatives first time in your life, okay, then you require 80 hours of preparation based on your professional background. So what could be the plan? Book your exam, you can say this week only, okay, and you can book in the first week of July or second week of July. Invest every day 1 or 2 hours, or weekly 10 to 15 hours. Enroll in Prep Cafe. We'll discuss later. You can enroll for the additional mock test. Apart from, we will give you a mock test, okay, for better preparation. Again, to help you, we have divided this training into broadly 5 modules, which cover the core syllabus of the training, okay, or the examination. So basic 15% weightage will cover today, okay, in first 4 hours. Tomorrow we'll go with the future and forward, which is a 20% in the exam weightage. Options, contract, 20% weightage, will do it in third day. Strategy, trading strategy, okay, another 15% weightage will do it day of 4. Operational and regulatory aspects on a day 5. So we will upload the each category PPT, okay. So PPT I'll share with you Google Drive link today itself. There is no need to worry, PPT is available right now. Question bank and mock test will upload in partner desk by 25th. I request you can book this examination this week only, okay. between 10 to 15 for a first week or second week of July based on your time investment. You can also reschedule your exam 2 times by NISM at no cost. So even I booked the 1st July, on a 30th June, I feel that I may not able to go for the exam because I'm not prepared. Okay, then again you get a chance to postpone. Okay, so there is no need to worry. 2-time rescheduling option is available. So here, any question, if you have any question, I request you can write it in the chat box or you can unmute and ask the question.
Excuse me, sir. One small question.
Yes, sir.
I have my MP card with me. I have my ARN card, mutual fund ARN card with me. I'm also a registered stockbroker. So I've given my derivatives exams. I've got the NISM derivatives certificate with me. Do I have to give this also exam also again?
Because if you have passed all 3 examinations, then you may be exempted. Otherwise, as per the CV guideline, okay, this is the.
Yeah, I passed all the 3. All the 3.
Then you just have a word with AMC because I am not able to give you a complete idea. Okay.
Okay.
Just here, if you go and read it, okay, distribution of the specialized. Okay, so an entity engaged in sale or distribution of mutual fund products shall also be eligible to offer under the SIF subject to each entity, such entity having passed NISM series 13 common derivative certification. Now they have not mentioned if you pass the another exam, you will be exempted or not. So you have to, once product is launched, then you have to connect with the AMC if they are allowing. Okay. Otherwise, the better option is that one should pass it, because in case if it is not allowed, then last moment it is quite difficult to register and pass the exam.
Yes, sir.
Yes. Clearly mentioned, there is no exemption criteria is mentioned like age or maybe other criteria. Simple criteria is there. Anyone want to sell this product? Okay, has to pass the examination.
Okay, sir. Thank you. Thank you very much.
Okay. Any other questions? In case if you can write it in chat box also. So someone mentioned, shall we get this PPT? Yes, end of the day, I'll share the Google Drive link where you can download the PPTs and the study material. If there is no question, okay, I request, if you don't have any question, I request you write in chat box no, so at least I can understand how many are actively listening to me. Okay, so I am happy that almost quite number of answers I got. Okay. So we just concluded the broad idea about the examination. Okay. So last we discussed about the assessment structure. Okay. 3 modules and how syllabus look like and how we are going to go through the training. Okay. So today we'll start with the basic of derivative, and to have a more quality learning. Now, please understand this is a technical curriculum, and in technical curriculum, to better measure the performance of the participant, there is a concept of pre-training. Okay, so once you attend this pre-training, okay, I humble request ki attend as like you are attending the exam, because many of you are excited right now. I want to go and attend the examination. So I am giving you a opportunity of, let's say, mock test of mini 10 minutes. Okay. Exam where 20 question is there. So you can test your current knowledge. Okay. Here we'll not discuss. Then we'll move to the chapter 1. Okay. Which is a basic equity. And then we'll go to the again post training. Okay. And then you will attend the post training test. Okay, so I humble request don't jump into the uh, all answers in 1 minute of time. Okay, because when you attend this even pre-trained and go through the read the each question twice, read the options twice, and based on current understanding you can answer. At least even if you do not know, no problem, at least you can come to know, okay, which are the learning we are going to get into our syllabus. Okay, so I am sharing you a first pre-training test of the day. Okay, so I am sharing you a form. Now I'll once you paste it or you click on that, okay, how it will look like. So this is the mention SIF pre-training test day one. If you have not logged in with the Google, you need to first log in Google, okay, on your mobile or on a website if you're using laptop, okay, and then you have a 10 questions and 4 options, okay. So you will select and then you submit the paper. So right now it is a 14:31. We'll take a 10-minute time, okay. So till it is the 14:41. So your time start now. I humble request ke please do not think ke what you are doing is right or wrong. Okay, I am carrying a 20 years of experience, having a professional qualification like CFA, CFP, training experience 20 years. So please follow it. Okay, it is like going to a doctor and suggesting doctor कि ये prescription मत करिए, ये prescription करिए. Okay, ये test मत करिए, ये मत करिए. So please, I humble request कि whatever you are attending, you are doing a first time in your life. Okay. But I may have done repeatedly in my professional career and help thousands of professionals to grow their business, grow their AUM. So I'm sure that I am clear to everyone. Last 3 minutes. Okay, last 1 minute. Please submit it. Okay, so now I request remaining participant, you can submit it and we can move to the our first chapter, basics of derivative. So in this chapter, basics of derivative, what are the learning objectives, meaning of derivatives and types of derivative product, okay, history of derivative markets, significance of derivative market, risk in derivative trading, okay. So what is derivative? So as per the book definition, a derivative is a contract or a product whose value is derived from the value of some other asset known as underlying. Okay. So if I say curd, okay, is a derivative product. What is the underlying? You can write it in a chat box. Yes, we'll update the result once we complete the training, and post-training we'll discuss the all 20 question, and I'll also share you the result also on your email. Okay, so curd is the derivative product, the underlying is the milk. So price of the curd is depend on the milk. So once again I'm reading, a derivative is a contract or a product whose value is derived from the value of some other asset known as a underlying. So which are the popular contract, okay, in derivatives? So metals such as gold, silver, aluminum, okay, energy resources like crude oil, okay, coal, electricity, natural gas, etc. Agri commodities such as wheat, sugar, coffee, cotton, pulses, etc. Financial asset like shares, bond, and foreign exchange. Okay, so our focus is only in this exam on a financial asset. Okay, any shares, equity, bonds, interest rate, and foreign exchange is currency. So let understand the global evolution of the derivative market. So I asked there could be a 15% information question. Okay, so from that point of view, I am giving you idea. Okay, when we discuss post trending and pre trending, you will get more clarity. So tulip mania was there. Okay, speculative tulip future was introduced. Okay, Japan's rice future. Okay, for hedging weather or war risk. 1848 CBOT facility provide contract. CBOT stand for Chicago Board of Trade. Okay, then again introduce the exchange traded derivatives. Okay, currency futures, listed options, treasury T-bond future, euro dollar first stock index future, options on S&P introduced. So this is the global evolution in the derivative market. What are the key drivers for the growth? Okay, this is across growth. There are 2.1 and 0.2 in one slide. So growth price drivers, why derivatives are right now popular in the global market, because increase the asset price volatility. So we know that even S&P 500, okay, in last 3 months, okay, from 6,000 level to 4,800 level, and again now 6,000 level. So it is a very high volatility. Index gone down by almost 20% and recovered that loss in within the 3-month period. Okay, so it is a increase the asset price volatility is the one of the most important reason. Second, global integration and technological advancement, reducing the transportation cost, enhance risk management, and continuous product innovation. So these are the 3 key drivers for the growth of the derivatives. Now, next slide is Indian derivative market. So how India derivative market is evolved. So first time in 1996, almost 30 years before, SEBI introduced the Dr. L.C. Gupta committee to frame the guidelines for derivative guidelines. 1999 Securities Contract Regulation Act amended to include derivatives as a security. June 2000, BSE and NSE introduced Nifty and Sensex Index future almost 25 years before. Okay. Okay, June 2001 roll out the index option. November 2001 individual stock option and future introduced. Okay, 2013 Metropolitan Stock Exchange enter in derivative arena. So this is the Indian journey about the derivative. This is information where one need to read twice, thrice to remember the content. Okay, and if question is asked, you can get the catch mark by remembering the important information. Now let's move into the products in the derivative market. So first product is the forward. Second is the, I request you keep mic mute. Okay, otherwise I have to keep everyone mute. Okay. So first product is forward. Second is the future. Third is the options, and fourth swaps. Okay, so one by one we'll learn the basics about this. Definitely today we are introducing the basics. Okay, definitely we'll learn tomorrow in detail futures and forward options on a day 3. Swaps is not in syllabus, so we'll not go through it. Okay. So what is the forward? So forward is a contractual agreement between two parties to buy or sell an underlying asset at a certain future date for a particular price that is pre-decided on date of contract. Both the contracting parties are committed and obliged to honor the transaction irrespective of the price of the underlying asset at time of delivery. Since forward are negotiated between two parties, okay, the terms and conditions of the contract are customized, and these are also known as a OTC, over the counter contract. So let me give you one simple example so you get a more clarity. Okay, so take an example of farmer, okay, that expected right now in rainy season, monsoon, okay, there is a crop planning for the crop, and next 3 months, okay, after 3 month crop is expected to ready, okay. So farmer today invest into the seeds, okay, fertilizer, etc., okay, and then after 3 months, and also putting the hard work, and after 3 months he is worried that when crop is ready, okay, there is a price drop, okay, and chances that he may end up with the loss, okay. So farmer on a one side is worried about the drop in the price. On another side, the company, like example I am taking ITC, okay, which is manufacture atta, they might be worried, okay, when crop is ready, okay, chances that the price may be high. So their raw material cost for the atta is wheat, so that may be a high. Okay, so what is the solution? If I give you a quick idea, okay, in 17th century, in Chicago, when farmers came, like in India also, what happened in India today, right now, in last 10 to 20 years, it was happened in 200 before, 300 years before, when farmer used to come with the wheat and rice crop, okay, example, and they do not get the adequate price and they dump this crop, okay, into Chicago River, and someone saw this situation, and that's how the future forward contract has started. Okay, so here farmer, okay, and the company who basically require raw material wheat to manufacture either bread or maybe a atta, okay, flour. So they can enter into agreement. Party one is farmer and party two is the company. And agreement is like today on a 10th June, okay, they will enter an agreement. Farmer says, I'll give you a 10,000 kg of wheat. Okay, particular quality is decided. Okay, quantity is decided. Price is decided today. Example, 40 rupees per kg. Okay, and the delivery date is also decided. Let's say on a 10th September example. So here both party, the farmer is a seller, okay, and the here party manufacturing company is the buyer. So this is known as a forward contract where quality, quantity, price is decided today between two parties, okay, and delivery date is decided in future, maybe after 1 month, 3 months, 6 months, okay, based on the discussion, okay, and this contract is known as a forward contract. If you have any specific query, you can write it in a chat box also, okay. So now we are moving ahead. I think there is no query. Okay, there is nothing not mentioned in chat box. So I'm moving ahead. So now second product. Now we are discussing it. I'm just introducing the concept right now. How forward product is known, is work. Okay, so this is the concept I have introduced. Now, second product is known as a future. Okay, you can say it is a upgraded version of forward only. Upgraded version of forward. How? So future is also like a forward. It is mentioned a future contract is similar to forward. Okay, except the deal is made through organized and regulated exchange rather than being a negotiated between two parties. Because problem in the forward contract is that by any chance if one party is default, okay, then another party is into problem. Okay, if there is a uh, uh, price rise in the market, farmer may say no, okay, to sell at a previously agreed price. Or sometime if price is lower in the market, then company may also renegotiate term or ask for the lower prices and either not buy. So it is a like a counterparty risk is there. What is the biggest risk in the forward contract is counterparty risk. And second risk is the liquidity. Someone want to exit before maturity. So before maturity cannot be exited due to some reason. So this is the both risk, counterparty risk and the illiquidity of the contract of forward is risk is eliminated or minimized with help of the future contract, because it is a future contract is similar to forward contract, except the deal is made through organized and regulated exchange rather than being negotiated directly between two parties. Future standardized contract in terms of lot size, maturity, date, etc. So farmer can do what? Farmer can sell wheat future, okay, on a exchange. Okay, so that's how farmer can reduce the risk, okay, of price drop by selling the wheat future on the exchange, or maybe company may buy long future, okay, to reduce the risk of increasing the price. So here the counterparty between these two is the exchange. So counterparty risk is reduced. We'll discuss detail in tomorrow. Option is also an interesting product. Okay, we'll discuss on our day 3 in detail. Here our objective is to learn the basic concept only. An option is a contract. So here I want to clarify buyer of the option. Buyer of the option is a gives the right but not obligation to buy or sell underlying on before stated date at a stated price, while buyer of option pays the premium and buys the right, and seller or writer of option receive the premium with the obligation to sell or buy the underlying asset if buyer right is exercised. Okay, so I'll try to make you a little easy. Okay, so example option. So it is like a buyer of option, okay, pays premium for example right, particular right. So let me give you one simple example which can be easy to understand. Okay, let's say one of real estate buyer. Okay, let's say you are a real estate, you want to buy a real estate example, and you have a budget of 1 crore. Okay, and suppose you like the property, okay, and you want to book this property. Okay, you say to the seller, okay, I'll pay you 50,000 rupees a token. Okay, that is a token. Okay, and you give me a 1 month right. Okay, so I'll come back in 1 month with the remaining amount. Okay, and I'll basically buy the property, so complete the transaction. But if I don't come in 1 month, okay, my 50,000 right is cancelled. So you can take this premium. Okay, so I have an option. So buyer of the option, that key, if the buyer comes within the 1 month, okay, then seller is obliged to sell the property at 1 crore. Okay, but in case if buyer doesn't want to buy due to any reason, if he'll get another better deal, okay, or he has postponed a decision due to any reason, any other reason, so he has a basically not an obligation to buy on or before the expiry of the particular contract. So this is the called option. We'll discuss in detail on a third day. So here there are two kind of options are there. Call option where the one can long the asset by right to buy, okay, and put option where again long has a right to sell. The put buyer of the put option has a right to sell. So we'll discuss on a third day in detail. Swaps again limited in the exam. Okay, so today we'll discuss it as per the syllabus. So a swap is an agreement between two parties to exchange the cash flow in the future according to the pre-arranged formula. Swaps, broadly speaking, a series of forward contracts. Swaps help market participants to manage risk associated with the volatile interest rate, currency exchange rate, and commodity prices. So in swap, popular contract is like one party, party one and party two example. So in that swap, one is paying the fixed interest rate, okay, so that based on the notional value, let's say $1 million or 1 crore, whatever, okay, so where pay the fixed interval every month or every quarter, which is decided for maybe a 3-year period or a 5-year period, and so party one will pay the fixed interest rate to party two, okay, and in lieu of that, party two will pay the floating interest rate. So it is pay, and this will receive the floating interest rate. So there are some institution, those who want to hedge their interest rate risk, okay, so they may enter into the swap contract where one party will pay the fixed interest rate and another party will pay the floating interest rate, okay. This is an institutional mechanism, okay, to hedge the interest rate risk. In currency also there is a contract for a 1 or 3 years period where the one party can pay the pre-decided US dollar, okay, in exchange of pre-decided rate of Indian rupee for a maybe 6-month period, okay, or 12-month period. So based on the requirement, their risk is either hedge or they can participate into the speculation also. So here we have discussed 4 broad products, okay, forwards, future, options, and swaps. If you have any query, you can write it in chat box. Even I love you can ask also, but let me give you opportunity because I don't want to make it a one-way session. So in case someone has a query, they can unmute and ask the question, okay. So someone has mentioned in the chat box, can you explain the option? Yes, tell me.
Put option example like real estate.
I didn't understood. आपने क्या बताया?
कॉल ऑप्शन में आपने बताया कि रियल एस्टेट बुक करने के लिए मैंने प्रीमियम दिया, 1 महीने के बाद मैं आऊंगा, for I can buy, right? So what about the put option example?
Okay, yes, good. So I'll indirectly explain the both concept, both the question, okay. So now please understand what I gave an example. It is the something which you can relate to it, okay. So here first someone is asked about the options. So option is very different product. Future and forward is quite easy to understand, but option is little bit difficult because you can say one more innovation in derivative products. So we are going to discuss in detail on day 3. But again, if I quickly revisit the slide, okay. So slide says that key buyer of option. Let me put it here. The buyer of option has a right but not obligation. Okay. So here two kind of right is there. Call option, which is the right to buy, and put option, which is a right to sell. Now to assess, to get this right, okay, to get this right, the buyer pays the non-refundable premium to the seller. Okay, non-refundable premium to the seller. So if I give you a simple example, okay, suppose you are a trader, example, simple example, and you are bullish on, example, Infosys share. Okay. Now one option is that you can buy 10 lakh rupees Infosys in cash market and hold maybe for a 1-2 month period. You are bullish. Okay. Example, bullish means you are expecting that right now price is 600, maybe a 2000 prices in next 1 or 2 months, example. Okay. So, but you don't have money. So you opted for a future contract where maybe by paying a 10%, okay, you have a position of 10 lakh. So you require only a 1 lakh rupees. So what future, what derivative market offer you a benefit where we have a leverage. Okay, so we need not to require full money, maybe a 10% or 20% money we can buy the 10 lakh rupees of contract, okay, or 10 lakh rupees worth of shares. Okay, now problem is that suppose you were bullish, but after 1 month when contract is completed, the share price was 1500 rupees. So you lost, let's say key example, per share 100 rupees, and contract was, let's say, I'm just assuming right now simplicity, let's say it is for 1000 shares, example, simplicity. So you lost the how much? 1 lakh rupees. I'll make it contract size, let's say 16 lakh rupees in simplicity. Okay, 16 lakh rupees contract size. Okay, by paying 1.6 lakh, you opted for the long position in future, but in future you have a commitment. Okay, so if you become a 2000, okay, buyer will get the 400 rupees per share, so 4 lakh benefit. Okay, and seller will lose the 4 lakh rupees. But here the price is reduced from 600 to 1500. It's not work as per your thought process, and you lost 1 lakh rupees, example. Now you want to minimize this risk. So you can say that key, I'll go for the option where I pay the premium. Okay, let's say it is a example of 50 rupees and lot size is 1000, example. I'm just taking an example. So you paid the 50,000 rupees premium. Now this is the maximum loss is decided. This is premium is maximum loss. Okay, so if goes to a 2000, you got 600. So 4 lakh profit minus 50,000, example, so 3.5 lakh profit. Now it becomes, due to any reason, the share become 1000 rupees price. So if you have bought a future, okay, then you have a loss of 6 lakh rupees. Okay, this is in future. But in option, you have opted for that. I want a right, but not obligation. If price does not move in my favor, I will not exercise option. So my loss is limited to only 50,000. Okay, so it is the, I gave an example of right, but not obligation. So my loss is limited to 50,000. Okay, So this is for a call option. Same way we can go for a put option example, where right to sell. Someone want to sell. Someone is bearish about the example Reliance Industries example, and he expects that the share price will move from 1500 to 1400 rupees. But I don't want to commit. I don't want to take a maximum loss, but fixed maximum loss. So premium is, I'm just assuming 50 rupees and lot size is 1000. So I paid 50,000 rupees premium. If price become a example from 1500 to maybe 1800 rupees, I'll say that my bet is not work. I lost 50,000 only. But if Reliance price is reduced from, let's say, 15,000 to 1200 rupees, so I got 300 rupees per share, and 1000 lot is there to 3 lakh rupees. And my net profit after deducting 50,000 is 2.5 lakh rupees. So this is I try to give you a simple example. We are going to learn in detail. Okay. Call means buy. Okay. Right to buy. Put means right to sell. If contract gives you right to buy, something is called call. Yes. Name is given by the derivative market, call. And if contract gives right to sell, it is known as a put. Yes. Very good. Okay. So now I am moving ahead in this PPT, and we have a market participants. We have a market participant. Who are the participant in this derivative market? And who are either...
Sir.
Yes, please.
I can understand this way. If I want to buy with 10% margin or 20% margin, I can complete the transaction, right? And if I don't want to pay 10% margin, 20% margin, I can pay only premium.
No, you cannot compare margin with the premium, because premium is the maximum loss you have, wherein margin, it may not be maximum loss. In future, we'll discuss in tomorrow. It is like a unlimited profit, unlimited loss. But versus option, it is a limited loss and potential for unlimited profit. So that's the reason it is called option.
Limited to premium amount.
Yes.
Okay, got it.
Okay, so
with regards to seller.
Yes.
The seller of the option, the premium is higher, no, sir?
Which is
the least risk, sir? Which is the least risk? Option buy or option sell?
Please understand that it is the market where someone is thinking opposite, then trade is happening. Okay, action is only facilitating the trade. Action is only facilitating the trade. Okay, so two opposite mind meets and trade happens. So we may not get into the which is a better or which is not better. We simply conclude this discussion right now in simplicity. In future or forward, okay, whether you are a buyer or seller, you have a unlimited profit and unlimited loss, because there is a commitment is there. Okay, where in the options, okay, buyer pays the premium, so limited loss and potential for unlimited profit. Okay, versus seller, limited premium, profit limited to the premium, and loss may be potentially unlimited. Okay, so here meeting of two opposite mind and contract happens. Remaining queries we'll discuss tomorrow, so there is no need to worry, because we need to complete the today equity as well as currency basics. Okay, so let me move So who are the market participants? That is most important. Those who are thinking opposite. So speculator or traders, okay, they basically here for speculation, okay, hedgers, we'll discuss. So there are three participants. We'll go one by one in detail. Okay. So market participants, speculators, they try to predict the future movements in the prices of underlying assets, and based on the view, take a position in derivative contract. So they take a unhedged position. Which position? Unhedged, or it is also known as a negged position. Okay. So they want to just speculate or trade to make a profit. Okay, like people in our country, okay, do in equity intraday. So in morning they decide to buy one share, and by the evening they sell it. Okay, so it is purely their thought that today XYZ share will go up, so they will buy. They think that someone will think it will reduce, it will go down, so someone will sell and transaction happen. Okay, so derivatives are preferred over the underlying assets for trading purpose. So very important statement from the exam perspective, exam point of view, important statement. Derivatives are preferred over underlying asset for trading purpose as they offer leverage. Leverage means you have a maybe 10% upfront payment is required. Okay. For a 1 lakh, you require 10,000 or maybe 10 lakh rupees contract value, you require 1 lakh, are less expensive. Cost of transaction is also lower than the cash market. Okay, and faster to execute. High volume can be possible. So it sometimes the institutional investor may not find easy to sell it in a cash market. So they do a position in the derivative markets, either buy or sell as per their requirement. So speculator we have understood. Now we'll move to the second, and then we'll take the question once we complete this. Hedger, so they face risk associated with the price of underlying asset and use derivative to reduce the risk. Okay, so the hedger by name suggests their objective is to reduce the risk. Okay, corporation, investing institution, banks all use derivative products to hedge or reduce their exposure to market variables such as the interest rate, share price, bond price, currency exchange, and commodity prices. Okay, if I give you simple example, okay, example one, I'm taking from the institutional investor only. Institutional investor have to pay 100 crore rupees to one of investor. Okay, after 3 months. Example. So now this is the one of the investor is exiting the their fund, and they have to pay the 100 crore rupees. Okay, in next 3 months, and they are worried that after 3 months there could be a price drop. Okay, so what can they do? They can create a short position. Okay, today for a 3-month future. So by doing this way, they can reduce the risk of downside, okay, and able to ensure that they will be able to lock their price, okay, either in currency also or maybe in interest rate can be possible. So objective is that they have some position in underlying, and to hedge this position and reduce the risk, they use this derivative market. Arbitrager. Arbitrage is a deal that produces profit by exploiting the price differences in the products in a two different market. Arbitrage originates when trader purchase an asset cheaply in one location and simultaneously arrange to sell at higher price in another location. Such opportunities are unlikely to persist for very long, since arbitrager would rush to this transaction and thus closing the price gap at a different location. So basically they do some kind of a encashing the price differences. Example, BSE and NSE in India, we have two exchange, and for XYZ share, okay, price is let's say 1500 rupees, and here same price is 1505. So they can buy from the NSE and sell on the BSE, and they have to do very in a fraction of second, because they would take a buy trade here and sell trade here simultaneously in a fraction of second. In case if they cannot do due to any reason, they may end up with the loss also. Okay, So arbitrager basically reduces the price gap between two different locations, okay, by profiting the buying selling in a different location.
Keyurji,
Yes, please.
generally when we trade, no, we are not allowed to do this, right? If I have bought something from NSE, I have to sell it in NSE. I cannot sell it in BSE, right?
No, I am just giving you example right now.
No, but I am trying to understand how do people use this? क्योंकि in my life also, I mean, we see this कि NSE में एक भाव चल रहा है, BSE में दूसरा भाव चल रहा है. But हम ये practically implement कैसे करते हैं? ये जो आप theory में पढ़ा रहे हो?
Just a minute. So basically, here we are talking from the not retail investor, from the institutional investors. Okay, so there could be a opportunity is available. Okay, where institutional investors. Okay, suppose there is a one institutional investor may have now we discuss right now only in the cash market. Okay, but here same thing can be do on a derivative segment also. Suppose investor in a cash market, let me take an example. Some investor is holding the stock, okay, they may think that I am getting an opportunity to sell at BSE, okay, at 1505, okay, and I can buy it same stock, maybe same 10,000 quantity or whatever the quantity, okay, and if they can do it, so by doing this they can generate the arbitrage. Now in that condition, it is not necessary always you use the immediate buy and immediate sales. It is like that I am selling my existing quantity on a one exchange and same time buying at a lower price, okay, on another exchange. So I'm just giving you a raw example. Same way in derivative segments, okay, if specifically in currency exchange, currency market, if there is a difference prices is there in derivative contract, so that institutional investor pursue this kind of arbitrage opportunity to profit from these price differences.
Got it, sir. Thank you, sir. Thank you so much.
My pleasure. My pleasure. Yes, we'll share you the PPT. Okay, so don't need to worry. Exporter and importer also go for this. Yes, they go for the foreign exchange. So they will use the derivative market to hedge their risk, specifically in the hedger segment. Again, tomorrow we'll discuss tomorrow or maybe a 4-day in derivatives trading strategy. Arbitrage is not only about the buying and selling on a different price, different location, but also basically calculating the fair value of the contract. Let's say if Nifty 50 example, June month contract price is, and then July month contract price is, August month contract price, and if there is some mispricing is there, okay, that mispricing is also encashed by selling the overvalued contract and buying the undervalued contract. Okay, so when the both contract will mature, okay, that riskless profit is generated. So that is also called arbitrage that we'll discuss in the derivative trading strategy. Now we'll move the types of derivative market. So there are two broad derivative markets are there: over the counter, and second is exchange traded. So over the traded contracts are tailor-made to fit the specific requirement of dealing counterparties. Okay, it's like a forward contracts mainly. Okay, management of the counterparty credit risk is decentralized and located with the individual institution. So it is the counterparty risk is not with the exchange and not with the platform. There could be OTC platform is there, okay, but OTC platform only the providing these services, okay, to enable the buyer and seller, but counterparty is risk is with the individual, this party 1 and party 2. There are no formal centralized limit on individual position or leverage or margining. There are no formal rules or mechanism for risk management to ensure market stability and integrity. For safeguarding the collectible interests of the participant, transactions are private with little or no disclosure in the entire market. So practically we don't know, okay, any electronic platform may be offering this kind of services. We don't know what could be the particular contract open positions, or what could be the their total contract size, etc. It is basically customized contract. So in exchange traded, which is overcome the limits of the forward contracts, because biggest risk in the OTC market is counterparty risk. Okay, which we discuss. Biggest risk is the counterparty risk. Okay, in the forward contract. Okay, so this is the overcome by the exchange traded derivatives. So exchange traded contracts are standardized, traded on organized exchange with prices determined by the interaction of buyers and sellers through anonymous auction platform. A clearing corporation guarantees the contract performance settlement of the transaction. So it is there is a transparency is there, liquidity is there. Okay, you can say no counterparty risk is there because of the settlement clearing corporation is there. Now we are moving ahead. Significance of the derivatives. So what is the significance? It helps improving the price discovery based on the actual valuation and expectations. Okay, so when specifically in our country, limited shares are in F&O. Okay, so chances that one micro cap or small cap which is not in F&O, so only people can buy, and price can be skyrocket because of the people cannot short sell the that share. But in developed country where both options are available, where one can long in the cash market or even short in the cash market. So by doing this, both options are available through cash market or through the derivatives market. It helps to improve the price discovery and based on the actual valuation and expectations. It enables the transfer of various risks from the who are exposed to the risk but have a low risk appetite. Okay, and participant with the high risk appetite. So someone who want to hedge their risk, they can hedge the risk. Okay, and someone will buy that risk. Either it could be a speculator or opposite side hedger. Like in currency, importer has a risk of dollar appreciation, where exporter has a risk of dollar depreciation. So both have a risk of dollar. So indirectly through exchange, okay, both are hedging, but both are opposite hedging, and both are benefited with the price fluctuation of the dollar. So they can eliminate the either dollar appreciation risk or depreciation risk. So for example, hedger wants to give away risk, whereas the traders are willing to take the risk. It enables the shift of speculative trade from an unorganized market to a organized market. Risk management mechanism and surveillance activity of various participants in the organized space provide the stability in the financial system. So quickly we'll discuss and conclude this chapter, and then I'll take query for 2-3 minutes. So various risks faced by participant like hedger, arbitrager, or traders in derivative. Now it is include the futures as well as forward. Okay, so it is like a derivatives, not only future. So counterparty risk, which is mainly faced in the forward contract, we discuss. Price risk, which is in both futures and forward. Liquidity risk, mainly into the forward market. Legal or regulatory risk, enforceability contract, mainly in forward market, because in future there is no need to worry because it is a counterparties exchange. Operational risk, fraud, inadequate document, improper, mainly in forward, because in future contract it is a counterparty is the exchange. Finally, a model risk disclosure document is issued by member of exchange and contain important information on trading in equity and F&O segments of exchange. All prospective participants should read document before trading on capital market, cash segment or F&O segment of the exchange. So it is very important that as per the SEBI guidelines, okay, that broker has to sign off the model disclosure document, and today SEBI is ensuring that every time you open the app or website and before you trade into the F&O, there is a disclosure is there about the risk and what kind of losses or potential of losses. So here we conclude this chapter. So let me go to the query. Okay. So either you can unmute and ask the query, or you can post your query into chat box.
Sir, what kind of questions are asked on this chapter in the exam?
Did you attend the pre-training test?
No, I haven't.
Okay, no problem. So we'll go through the right now post-training test, and then we'll discuss the both pre and post-training test. Okay.
Okay, sir.
I'll share both once again, but first I'll share you post-training test. Okay, so you can attend right now, and then pre-training test once again I'll share, but that you can attend later part after 6 o'clock for your reference if you want to attend. But we are going to discuss both tests because almost 100 odd participants attended. So we are going to discuss both one. Okay. Yes, tell me.
Can you, did you cover like what will be covering in the next, whatever, 3, 4, 5 days?
Yes. We started 2 o'clock and we discussed.
Okay.
I'll show you the PPT. Okay. So once you download the PPT, you can go through the initial
right, sir.
content you missed out in case.
Right, sir. Thank you.
So last question, I'll take it about the model disclosure document. Now, please understand, this is a reference to the examination. If we discuss, it is like a risk disclosure. Okay, suppose you want to trade in the F&O segment. Okay, then there is a additional requirement is there. Okay, an additional requirement. One of the additional requirement is that the broker will digitally. Earlier, people used to sign physically, but post COVID, they will give you that disclosure agreement where you read it, and once you do your other verification or your OTP based verification, it is that you have accepted this. So it talk about the what kind of the risk involved in basically doing a trading as a retail investor into derivative segment. So that is the main objective of the SEBI. So right now, let's first go to the post-training test. Okay. So I'll go to the post-training test. So I am sharing you a post-training test. So once you click on that, I'm showing you here. Okay. So this is the so it is mentioned as a SIF post-training test day 1 equity basics. So in case if you're not Google signed in your mobile or laptop, you need to sign, and then you have to submit it. You need to have your email ID. So now you have 10 questions. I request you read thoroughly each question, 4 options, and based on last 1.5 hour learning, okay, you select the option. So 10 minutes time you have, and after that you can submit the paper. Okay, there is no negative marking, so you need to select one out of four. Okay, your time start now. So time is 15:31. So it is 10 minutes time to 15:41. Okay, I humble request take it this test as a exam test only, because similar kind of question will be asked in the exam. This is the Google form. So you need to click on the link and attend the, if you are attending on mobile, you can log in through Gmail. Okay, if it is already login, then you have to attend it and submit it paper as I discussed. It's a multi-choice options are there, so there is no need to worry. Okay, last 4 minutes. Total 90 members gave the pre-training test. Okay, last 2 minutes. Please submit कर दीजिए. Yes, I'll release it after the discussion. So once first we'll discuss the post-training test, and then I'll release the post-training test score, and then we'll discuss pre-training test, and we'll release the pre-training test. So we'll get same way on your email. So if I just discuss quickly, so average score 6.3, okay, versus the year it is a 7.6. So good, very good. I think the participants here are having the basic knowledge. If I say in pre-training test 1, 2, 3, 3 plus 8, 11, 11 plus 6, 17, 17 plus 16, which is approximately 33 participants got 5 or below. Here in post-training 3, 3, 9, 9 plus 7. Almost half of the participant got the lower than the 5. So it means that there is a learning. Earlier in first pre-training test 5 and below 36 participant, here it is a lower than that. We will share the result, no need to worry. Okay, now we'll go to the first pre-training test solution. Okay, so let's start with the humble request कि even though you have attended right, okay, chances that you have attended right based on skill also, or based on luck also, or guessing and luck only. So right now this is a one more opportunity to go through the revision. So I request everyone to go through attend this all 20 questions thoroughly, and if you have any question you can unmute and ask the question. So in next 20 minutes we'll solve both pre-training and post-training test, and then we'll take a quick break for 5 minutes for the refresh 42405, and then we'll start the second part, which is the derivatives, that is the currency basics. Okay, so let me take my own only to avoid the any email of anyone. Okay, so let's start with the first. So which of the following is explicitly listed as a risk inherent in a derivative trading due to their leverage nature? Okay, so we are talking about the risk, okay, inherent risk in derivative trading, which includes the future, forward, swaps. Okay, so one is geopolitical risk, counterparty risk, inflation risk, dividend risk impacting the underlying. So now I am giving you some kind of a guidance. Okay, when you go through the real examination in NISM center, you will see that out of 4 options, 2 might be irrelevant, which you can eliminate easily, like inherent risk in derivative, inflation risk is irrelevant, dividend risk irrelevant. So you understand that mostly in MCQ, out of 4 options, 2 can be answer eliminated, okay, with our common sense or with our knowledge and skill set, and balance 2 answers if we go. So we have not discussed about geopolitical risk. We have discussed the various risks. If you, I'll just open once again this PPT. Okay, so you get a clarity. Okay, here last slide it talk about the counterparty risk, price risk, liquidity risk, legal or regulatory risk, operational risk. It doesn't talk about the geopolitical risk. Okay, so that's the reason the right answer is counterparty risk. Okay, if you have any question, you can unmute and ask. Okay.
Sorry, I didn't get the counterparty risk here, because the counterparty risk is getting mitigated, especially in exchange traded derivatives, right? I understand forwards has counterparty risk, but in general they mention derivatives here.
No,
So how
derivative is in
we
general only. Na? Derivative includes all 4. It doesn't talk about the exchange traded. Na? When I talk about derivative products, okay, here in this slide, okay, so I mentioned about 4 products. Na? So I have not discriminated specifically. Okay, I am talking about future. So that derivative includes all 4 product, and here also risk.
நல்லா இருக்கீங்களா? வாங்க உட்காருங்க. ரொம்ப நாள் ஆச்சு.
Noted.
Okay, and risk also, it is about the derivatives, not about the particular product in the derivative. It is about the derivative as a complete basket. Okay, so that's the reason it is very important. Now next question is, which of the type of the market participant should exercise extra caution before engaging in derivative trading? So which participant should be careful? Okay, individual with large resources, extensive trading experience, high risk tolerance. I'm not saying yes or no, but I'm going with the second. Participant with extensive trading experience, institutional investor and hedge fund. And 4th option is individual with limited resources, limited trading experience, and low risk tolerance. So which should be more careful? The individual with limited resources, limited trading experience, and low risk. Which of the following is identified major factor driving the global growth of derivative market? So why there is a global growth in the derivative market? We discuss 2-3 important points. I'm just reading the standardization, eliminating the need for contract. That is the one of the reason instead of forward, but to future, but not the major reason. Enhance exchange guarantee, eliminating the counterparty risk may be a reason, but not major. Increase the price stability. No, it is a increase the price volatility in underlying asset prices in the financial market. So we discuss significance of the derivative, if you can recollect, or when you read 2 to 3 times, okay, and understand it, okay, you will be able to answer correct it. So it is all about your syllabus is important. You need to follow the syllabus. So this is the growth driver. So increase the asset price volatility. That is the first reason. Global integration, technological advancement, enhanced risk management, and continuous product innovations. Next question, what is the fundamental definition of derivative? Very simple. Okay, a contract whose value is derived from the value of another asset called underlying. for the derivatives. What is the defining characteristics of OTC derivative compared to the exchange derivative? So we have understood that OTC derivative is customized, okay, by bilateral, okay, having the counterparty risk. So here contracts are standardized and traded on anonymous auction platform. It is for future. A clearing corporation, again, this is for the future. There are formal centralized limit, again it is for future. So what is for forward, contracts are tailor-made to fit the specific requirement of the counterparty. This is the right. Why are pure arbitrage opportunities unlikely to persist for a very long inefficient market? Because arbitrage opportunity hedges quickly absorb the available risk. Okay, speculator quickly absorb all available risk. Transaction cost for derivative eventually exceed the potential profit. Arbitrager rush to exploit the price difference and eliminate the gap. So the D is the right answer, where when there is an opportunity, arbitrager exploit the price difference. So automatically for a short period it could be persist the difference. Which of the following is the reason why speculator trader prefer using derivative over the underlying assets? So we have discussed, because compared to the cash market, derivative has a leverage. So you require a lower amount. In cash market for a 10 lakh contract, you require same 10 lakh, but in derivative market, maybe 10%, only 1 lakh. Okay, so it is a leverage. It is a higher volume can be possible. And third is the we discussed the faster execution. So derivatives offer leverage, lower transaction cost, and faster execution of the large volume. So sometimes you have to be careful between two options also. Two you can identify easily, wrong option, but for one there could be a minor difference is there. Here everything is same, but it is mentioned small volume. Okay, so if you make unnecessary hurry and you don't read properly, chances that you may end up with the negative result. Okay, so it means that you need to read question twice, read all four options twice, and then take a right decision. Which of the following statement is true about derivatives? Okay, forwards are standardized contract, false. Option contract require buyer to pay MTM, no. It is maximum premium is required one time. Swaps are typically negotiated and regulated auction, no. It is again like a forward bilateral contract. So future contracts are essentially forward contracts that are traded on the exchange. What is the primary characteristics of forward contract in the derivative market? So it is a customized OTC obliging both parties to transact. This is a right statement. Last question, what is the primary purpose of hedger using the derivative market? Objective is to reduce the risk we discussed. So reduce the risk of associated with the underlying prices. So any question in this question, if you have any question, we can quickly discuss in 1 minute. Okay.
So in one of the questions, even the speculators can also try to find out the difference, right? The arbitrage question.
No, speculator is basically using for the why speculator traders are using, not for arbitrage, because
not this one. Sorry, not this one. The arbitrage question. Yeah, this one. Even speculators can also quickly observe the difference in the market, and they can also try to close it, right?
Now, please understand that three distinct type of entities there. Please understand. One is the investor. Okay, those who come in derivatives only for hedging the risk. If I'm a exporter, okay, like Infosys, I don't want to play in the currency market. I want to just hedge the dollar risk. I am taking my business risk. Importer, they don't want to oil refine the oil that OMC we call oil marketing company. They don't want to play the dollar risk. They want to only hedge the risk. Okay, because they want to take their business risk. So they don't want to go for the arbitrage. Same way, speculator is interested in a bet. So any speculator want a low investment, high return in a quick period. Wherein arbitrage it is like getting a small money by taking a opposite trade in a fraction of second. So there are specialists is there, maybe institutional investor only. They are doing now it could be their vertical also, but they are only doing this arbitrage work only. So they might not be doing speculation and that hedging. So there is a 3 different category of people are there. Okay, they mainly like to do their own activity.
Noted. Thank you, sir.
Okay, so now we'll move to the next test. Okay, now I am not releasing right now, otherwise you may not involve, and you may distracted towards checking your score. So I'll release both pre-training and post-training score after these pre-training test question solving. Then we'll give the 5-minute break so you can refresh yourself as well as check your score also. So now I'm moving quickly into the pre-training test. Okay, I'm taking first paper my only. So what is the primary purpose of the model risk disclosure document? Okay, so to provide detailed market forecast and trend to prospective trader, no. To explain enforceability of contract, no. To outline standardized trading procedure, no. So what is the objective? To offer comprehensive information about the risk of the trading in equity and F&O segment, which we have listed in the our slide. What was the critical initial regulatory step taken by SEBI to develop derivative market in India? So what was the critical initial regulatory step? What was the first step to develop the derivative market in India? So first step was appointing the Dr. L.C. Gupta committee in 1986 to frame the guidelines for the regulatory framework. And once it is come, then they have amended the SCRA Act and included derivative as a security. And then third, the NSE and BSE launched the index futures and option, and then the stock futures and options. Which measure was crucial laying the regulatory foundation for derivative trading in India as described, okay, in the textbook, okay, or what we have learned in the slide. So what is the regulatory foundation? Prohibiting forward trading completely for 3 decades, no aisa kuch hai nahi. Launching Metropolitan Stock Exchange as the first derivative platform, that was came in 2013. Introducing stock future on global indices before domestic indices, no. So amendment of Securities Contract Regulation Act to include derivatives as a security, because in India when this act came in 1956, derivative was not included. Until derivative is not included, we cannot consider as a security. So SEBI has amended the act, or government of India has amended the act, and then derivative contract has started in India. What is the fundamental definition of derivative? Repeated questions. Contract whose value derived from the underlying assets. Arbitrageurs in derivative market are best described as a participant who. Arbitrager basically like to profit from the buying and selling at a different price. So exploit the price difference across the market to earn the risk-free profit. Which of the following best describe role of hedgers in the derivative market? So hedger, we have learned their objective is to reduce the risk. So they use derivative to reduce the risk exposure associated with the underlying price fluctuation. What best describe this swap in the context of derivative market? So it is a series of forward contract exchange cash flow based on the pre-arranged formula. In option contract, what best describe the seller or writer role? So we have learned that writer or seller earn the premium. Earn means receive the premium and have a obligation. So seller receives the premium and is obliged to buy or sell the underlying asset if buyer decide to exercise the option. Which feature distinguish a future contract from forward contract? Okay, so there is a difference between future and forward. So future contract are customizable, false. Future contracts give the buyer right but no obligation, false. Future contract involve exchange cash flow, that is in the swap, not in the future. Future contracts are standardized and traded on the exchange. This is the right statement. Which one of the significant function of derivative market? Okay, it facilitates the transfer of risk from participant with high risk appetite to those with low risk appetite. So it is a false. So it is the right is the it facilitates the transfer of participant with low risk appetite to those with the high risk appetite. So any question here in the 10 question, if you have any question, we can discuss for 2 minutes. Okay. If no, then I can release the score. Can you explain the last question? Okay. So last question says that key which of the significant function of derivative market, why we are going with derivative? So hedger, specifically hedger, what they want to do, they want to reduce their risk. So they reduce the risk means how I can write it in English language. It facilitates the transfer of risk with low risk appetite to those with the high risk appetite. So people who having a low risk appetite, they can transfer their risk to the high risk appetite. Okay. So it is basically a significant function of the derivative market. Okay, so release these. Let me release the test score both. I am first releasing the pre-training test. Okay. The answer means the result may come on your inbox or maybe a spam box. So check your all available options. Okay. And now I'm sharing you a test score for post-training test. Okay, so we are in time. So let's take a 5-minute quick break. 5 minutes quick break. So in that break, you can refresh yourself, also go through your result. And if you have any okay, so it is mentioned SIF pre-training test day 1 for currency basic. So I request read this each question twice. Okay. And read the options also thoroughly 2 times and select the right answers. I humble request, this is an online test, so I request do not do any cheating also, because it is for your own improvement, because your pre-training test, post-training test is confidential. Okay, so I am not sharing to group. Okay, so that's how you understand where you are, and after training you will realize how much improvement is there. Right now our objective is okay is about the in exam also you have a 10 question. Okay, so 10 minutes, that's the reason we are giving. Okay, so time is 16:08, so 10 minutes till 16:18. Okay, last 5 minutes. Okay, last 2 minutes. Okay, last 1 minute. I request. Yes, this is the currency. Okay, so we are starting right now. We got 50 response, and average is 3.94, which shows that key it is a new subject to you. So there is no need to worry. You need to be attentive in learning for next 1.5 hour. Okay, so next 1.5 we will go through the basics of currency. Okay, and then again last half an hour we'll use 30 minutes to solve the both pre and post training test. Okay, so now let move ahead in the journey. So FX, it is known as a short form, and currency derivatives. Okay, so our objective is to learn about the basics of currency derivative. So I humble request you need to be attentive, as well as you can use pen paper to note down some important thing, because a lot of new content is with you. Until now it is not objective right now that you remember everything, but once you complete it training and then you go through 2-3 times, it will be familiarity will increase. Okay, so major currencies and currency pair. So currency pair, it is a relative value of one currency with another. Okay, like say USD INR, okay, 85. So it says that USD, 1 USD is equal to 85 rupees. Okay, so what are the major currency? All the important information can be tested in the exam. Okay, so that's the reason I have put it on a slide. So which are the major currency in the world? Euro, USD, Japanese yen, Great British Pound, Australian dollar, Canadian dollar, and Swiss franc. Okay, so 1, 2, 3, 4, 5, 6, and 7 are known as a major currencies. Okay, there could be 200 countries in the world, but major currencies are 7. What are the key pair? Key pair means key where trade is happening. Okay, most trade. So Euro USD. Okay, so 1 euro is equal to how many USD? So Euro USD Japanese yen. Okay, Great British Pound USD, AUD USD, USD CAD, USD CA and Yuan China, USD again Swiss franc. Okay, so these are the key pair. Okay, minor or cross pair. Okay, so this is the major currency and major pair, you can say. And what are the minor pair, which is the non-USD pair? Okay, so where USD is not there, in all key pair you understand USD is there. Okay, first or second. But when I call minor or cross, okay, it is a non-USD. So it is like a Euro GBP, Euro JPY, Euro Swiss franc. Okay, and last in this slide is exotic. Okay, these are all name given by the you can say currency market. Okay, so we have to remember exotic means a major with an emergency market currency. Okay, so there is a USD IND. Okay, again it is an exotic pair because it is an emerging market. Okay, so major with emerging market USD TRY, Turkish lira. Okay, it is known as a exotic pair. USD South Korean currency. Okay, it is known as a exotic pair. If you have any question in this, okay, you can post in a chat box. Otherwise, it is all information which you need to familiar, and you can familiar by repeating this content 2 times, 3 times, okay, during this journey of the post training, or maybe more than that if it is required. Now again we'll continue the discussion. Major currency highlights. Okay, USD, world's most traded currency, Federal Reserve notes. So it is also known as a reserve currency. Okay, because many of time like country like India, they trade in USD with Saudi Arabia, China, or maybe even in other country. So in olden 50 years before, there was no electronic trade, so they issued the physical bond, and that physical bond or physical note known as a greenbacks. Okay, key vehicle, reserve, and transaction currency. So USD is known as a vehicle currency, reserve currency, and transaction currency. So vehicle currency means what happened that key, if I want to buy, example, Thailand currency, okay, Thai BAHT, baht, chances that ki INR BAHT is not available. So what is the best option is that ki I use to convert my money to USD and then USD to that BAHT. So this is called the vehicle currency. So I use vehicle USD or Euro to convert into the some emerging market, or maybe some third party different third currency, because of the trade may not possible directly. Reserve means ki where the central bank like RBI keep money, reserve money into the USD. And transaction currency. So even though we may not be dealing with the USD, Okay, we might be doing with the trade with Saudi Arabia, but transaction is done in the USD. So it is called transaction currency. Okay. Euro official currency for 20 euro state managed by the ECB, European Central Bank. Second most traded central European trade and finance. Japanese yen, third most traded, highly liquid, popular in carry trades. We'll discuss later when we'll go to a future. British pound, historical reference, it is also known as a cable, major against the USD euro, and fourth most traded held reserve currency. USD CNY not available in 7 currency. No, this is the just example. Key pair. What is the question? It is there, na? USD CNY is there. It is in key pair. Okay, now we'll move ahead. First, largest first is the US dollar, second is the euro, third is Japanese yen, fourth is the British pound. Swiss franc, safe haven currency, benefit from Swiss stability and liquidity. Indian rupee. So it is very important from exam point of view. Manage float by RBI, play a key role regionally despite lower turnover. So it is the managed float currency where there is a RBI intervention is there. It is not free float currency. We'll discuss. I'll just give you a valuation. There could be a free float currency, manage float, and then fix rate. Okay, so free float where it is a demand and supply drives the price. Specifically, USD, Euro is the currency which depend on the demand supply. Okay, and definitely economic situation of that country. So most important is that no government intervention. So government is not decide the drive the prices high or low. Manage float like India, specifically in emerging country where RBI like to keep in a certain range. Okay, so when there is a depreciation of rupee, they like to sell the dollar, or appreciation they like to buy a dollar. So it is a managed float and fixed rate. Like example in Middle East country. So many Middle East country, their currency is pegged to the USD. So more or less rate is fixed. Minor variation is there, but it is called the fixed rate currency pegged against the US dollar. Okay, so now let's move ahead in the discussion. So this is the global turnover, just information. USD 88.4%, Euro, Japanese yen, GBP, INR, not total exceed 100% as each trade involves two currency, because in currency you buy one currency, INR example, and sell example USD, or vice versa. So two currencies involved, so turnover is more than 100%. Again, very important overview of the international currency market. Global 24-hour market operates continuously via overlapping session. Okay, UK, Europe, US, Asia. So it is a 24-hour market. Participants like banks, corporations, central bank, hedge fund, retail brokers. Okay, investor. Key characteristic: it is a decentralized OTC market. Transition from fixed to floating rate post 1971. Price driven by supply and demand near identical rates across the center. So there is a, okay, we'll discuss one come. So pre-1970, pre-1971, USD was pegged to the gold. So Fed Reserve used to keep the gold equivalent amount of the value. They print the dollar. and then other currency. Okay, that's other currencies like euro. Euro was not there, but GBP or maybe INR indirectly pegged to the USD. Okay, that was in pre 1971. Post 1971, they stopped that pegging. They started printing more dollars. Okay, without keeping the dollar. That's gold, and that's all prices. It become the driven by the demand and supply, and the as well as the economic situation of the country. Market scale daily OTC FX turnover USD 7.5 trillion, includes the spot, forward, and swap option. Hopefully, you are getting the slides. If yes, then you can write yes. In case if you have a question, you can write question. So at least I can understand how many are the active participants. Yes, definitely. This is a tough content, but more you revisit, okay, it is like a information familiarity we need to build. So more you revisit, okay, post training, maybe once in a 3 day, once in a week till the examination, you get a better familiarity. So now let move ahead into the one question is that what is the decentralized OTC market? So decentralized means every country has their own OTC market. Okay, so it is called decentralized because across the world we cannot have a one exchange. Okay, for the currency. So it is like a decentralized. Again, right now in OTC market also it is an electronic platform. Okay. So it is a over the traded counter where two parties meet online, and as per their requirement, they do a contract of buy sell, okay, hedge, etc. Kindly throw some light on Bretton Woods agreement. So definitely, I think we are going to cover, but partly I have covered in the previous slide. Okay, so this is the exactly Bretton Woods agreement pre 1971, where USD was pegged to the gold. So the currency they print, the Fed Reserve has to keep the equivalent amount of the gold. Okay, so that is called Bretton Woods agreement. Post 1970, they stopped keeping the equivalent amount gold, and then currency, other market currency also stopped basically keeping the that's as per the USD. Then it is a from fixed to floating market. How come the Middle East tag to the USD with some minor variation? So it is a country choice. So as I said that today country has a choice. Either they can keep their currency free float. Okay, so developed country like Euro, USD example, they have a free float. Currently, like India, they want to keep stability of their price, so they have a managed float currency. And some country, like example, you keep Hong Kong also as a pegged with the dollar. Okay, even in Middle East country, so they decided that our rate is particular multiple of the dollar. Okay, so practically speaking, it is a country's central bank decision. Now we will not go what are the benefit of keeping a free float, managed float that's fixed rate, because it is beyond the syllabus. So we are not discussing. No, China yuan is not pegged. It is managed float. Okay, now we are moving ahead in the discussion. So basics of the currency market, currency pair. Okay, so core concept. In foreign exchange, every trade involves the currency pair, buying a one currency while selling the another. It is like someone want to go to USA, okay, for vacation, okay, Indian citizen example, planning to go to USA for a vacation. So that Indian citizen requires, okay, US dollar. So they will sell the Indian rupee and buy the US dollar, or vice versa. Any NRI coming from USA to India for a vacation, that NRI required to sell the USD and buy the Indian rupees. Okay. So single currency can have a different value depending on the counterpart. USD, as per exam, I am going as per a book, maybe 78 against the INR, but 115 against the JPY. Dynamic nature, the value of each currency in a pair is influenced by economic conditions of the respective countries. Okay, major pairs dealers must actively monitor global economic development and stay informed. So it is a basically linked to the economy. Okay, we'll discuss also how economic situation make the currency either appreciating or depreciating. Trading environment, many transaction occurs over the counter outside the traditional stock exchange using the electronic platform. Okay. Now, this is very important. This is from here we are starting with the concepts. Till the time it was more about the information. Okay, learning the information. Slide 1, 2, 3, 4, 5, all about the learning the information. Okay, and from here we are moving towards the concept. Currency pair structure. Every FX trade involves two currency. Instead of foreign and domestic, we use base currency. The price currency usually in fixed unit. So when I say USD INR, so first currency which I am writing, it is called a base currency. Okay, and INR is the quote currency. Okay, so base currency means I say 1 USD, 1 unit of USD, how many rupees we have to pay or we get. Okay, so quotation currency, currency in which the base currency is expressed. Okay, so BC code is written first. USD, INR, USD is the base currency, INR is a quote currency. Example, quote of 75 means 1 USD is equal to 75. And GBP USD 1.34 means 1 GBP is equal to 1.34 USD. Okay, so very important from the concept and exam. Okay, there was one question was in pre-training or post or maybe come in post-training. Base currency. Okay, will come. So first base I'm just writing once again. USD INR when right, so it is a base currency and this is the quote currency, and it measures in a 1 unit of base currency example. Now next, market convention and pricing. In the interbank market, USD is generally universal BC. So in India we know that it is used as a 1 USD. How many dollar, how many rupees, not vice versa, except against the Euro, GBP or Australian dollar. So only exception with the Euro, GBP, AUD. FX quote shows bid, broker buys and asks, broker sells. So let me just give you important clarity about the bid offer spread. Bid, this is in any market. Right now we are discussing bid offer spread reference to the currency market. Okay. So suppose your price is example 85.50 25 and 85.75 75. Okay. So now let me ask you some question you have to answer in chat box. So I understand if there is some. Let me do an interactive discussion. So bid offer spread is reference to is a market maker or the investor. Investor means that someone want to buy user. You have to write it in chat box. The quote bid offer spread is reference to market maker, okay, and or user. So let me check. I request everyone write only 5-6 answers. Everyone participate. So right answer is the market maker. Very important. This quote is given by the quote itself. This quote is given by market maker. Let's say in our simple sense, it is like a bank, because we go to a bank. I want to go to USA for a vacation and I want 10,000 USD. Okay, so bank will give me a quote. Okay, so let me once again write. I'm just writing once again. So this quote is prepared by the market maker 85.5025 and 85.7575. So this is known as a bid and this is known as offer. Very important discussion. Please keep your attention here. So bid means market maker buy. Market maker buy. What buy? Because this rate is USD INR. This rate is USD INR. 1 USD is equal to this. So market maker buy USD. What they will buy USD? This rate. Okay, and market maker sells USD. Okay, at this offer rate. Okay, so please understand. Okay, this is from the market maker. Now user, if we say, suppose I am a user. Okay, I want to go for a vacation to USA and I need 10,000 USD. Okay, so I want to buy. So I have to check. Okay, I want to buy. So at that time, who will sell? Okay, market maker. So which quote will be applicable? Offer rate. So when user want to buy USD, the rate at which sale will be done by market maker at offer rate. Or when anyone coming to India from USA and want to sell USD, user want to sell USD example. To market maker, which rate? Bid rate. Okay, hopefully it is a clear. This is applicable in all trade, including equity, etc. But I am just giving you a clarity reference to the examination point of view. Let me move ahead in the PPT. Once we do some question in pre and post training, so we'll get more clarity. So direct and indirect quote, very important discussion. Direct quote, when foreign currency is basic currency, it is called direct quote. So USD INR is known as a direct quote. Okay, so when you learn the foreign currency market, you have to think that you are an Indian and you are basically thinking from the Indian person. Okay, and you want to buy let's say dollar. Okay, so when you get this USD INR quote, so it is called direct quote, and indirect quote means INR USD. So where domestic currency is the base currency. So first is INR USD, it is called indirect quote. So very important from the examination point of view. So hopefully it is a clear. Okay, let me move ahead. So again, this is explained bid offer spread in detail. Quote structure, market makers, bank provide a two-way quote. Bid price at which they buy the base currency, and U means user sell the currency. Offer price means price at which they sell the base currency, and you as a user buy it. Example, USD INR quote is 75.0550, 75.060, 75.0550 is a bid, and 75.06 is the ask price, and difference is known as a spread. Okay, so here offer price minus bid price, the answer will come is a spread. So let me ask you a question. If this is the quote and you have to answer this in a chat box, what is the spread? Use your calculator and calculate and share the answer in a chat box. Very good. 0.2550. So this is the spread. Okay. So again, I'm repeating, quotes are always from market maker perspective. Bid lower price presented first, followed by the offer price. Quote price is valid for specific quantity. Okay, larger volumes may require wider spread. If you go and ask for the 100,000 USD, chances that bank may quote a higher spread also. Market norms. So very important discussion again from exam perspective. For pair quoted 4 decimal. So which pair? I specifically use the 85 point example 2550, 85.7575. So there is a 4 decimal is there. So in USD INR, Euro USD, GBP USD, here all use the 4 decimal. Okay, 2 decimal use mainly in USD JPY. Now next is the appreciation and depreciation in the foreign market, foreign currency, dynamic exchange rate. Currency constantly fluctuate and price changes as one currency strengthen, appreciate or weaken. Or, yes, tell me.
सर अभी जो पेयर्स वाला बताया ना आपने 4 पॉइंट्स, और उस पे भी ऐसा क्वेश्चन कोई आ सकता है, ऐसा कुछ सिंपल सर?
यस, आएगा ना, क्योंकि आपको पूछा होगा कि आपका टिक साइज क्या है. हम देखेंगे आगे जाके कि टिक वंस टिक साइज एंड अगेन इफ देयर इज अ मूवमेंट हाउ टू कैलकुलेट द नेक्स्ट प्राइस, we'll discuss. One question is RBI market maker? No, RBI is not market maker. RBI is basically ensuring the price stability of the USD INR through the intervention. Okay, market maker is mainly a bank or FX. That's some kind of you can say like IBIX cash who supply, sell and buy the USD INR. Okay, so now let go ahead. Appreciation example, when BC can buy more quotation currency. Okay, let's say USD price is moved in 1 year, let's say 82 to 82.25 example. So it means that USD strengthen and INR weaken. Depreciation, when base currency can buy fewer unit of quotation currency, let's say move from 83 to 82, indicate that USD weaken and INR strengthen. Trading implication, buying a pair shows a bullish view on a base currency, expecting its value to rise, while selling suggests the bearish outlook on base currency. Suppose in currency trading, okay, currency future, when we learn tomorrow. So when I buy USD INR future example, future contract, and tomorrow I'll discuss more detail. Let's say one contract is equal to 1 USD. So when I buy USD future contract, means I am expecting USD appreciate, or I can say expecting INR depreciate. Okay, that is a trader's expectations. Okay, or someone sells, then it is the opposite expectations. Expectation USD may weak, okay, or expectation that INR may strengthen. Relative measures, appreciation and depreciation is always relative. For instance, USD might appreciate against the INR, yet depreciate against the euro. Again, some of the information question. Standard market hours India की बात करें, in India FCY INR transaction यानी कि foreign exchange transaction interbank and client standard time is 9 to 5 working days. Beyond normal hours, authorized dealers may transact with both domestic and overseas client and interbank trade beyond the market hours. So retail is all about the 9 to 5, but maybe some institutional client, okay, domestic institutional client or overseas client may go beyond the working hours. Value cash transaction are limited to up to 5, except for individual account which may trade on weekend or holiday as per bank policy. Normally it is 9 to 5 only, okay, but bank may give option, okay, to buy sell even in weekend, etc. Again, this is not important right now from exam point of view, so I'm skipping to avoid the confusion. Next is the forex rates and price discovery. So forex rate, base rate derived from interbank spot rate. So cash market rate is known as a spot rate. So in derivatives, whenever you come to know spot rate means it is a cash market rate. Adjusted for cash spot differences, okay, banks set the card rate for retail, revising the high volatility. Card rate means that bank may give the fixed rate, okay, to the retail users, okay, because for a day it is a fix, so it is called a card rate for a small transactions. Predominantly wholesale OTC market price discovery, okay. USD INR market hours already we discussed 9 to 5, okay. Continuous real-time rate assessment with limited arbitrage opportunity. Rising importance of non-deliverable forward, we'll discuss tomorrow about it. There is a one you can say authority, or you can say FBIL, okay, reference rate and forward premium curve. So FBIL reference rate, so it is like a entity which basically provide the reference rate for the exchange, which could be the opening rate for trading or closing rate, etc. Published daily 1:30 Mumbai business day for USD INR, Euro INR, etc. Computed transaction data random 50 minutes window between 11:30 to 12:30, so that compute based on the transaction data. Volume weighted average outlier removal, so it is derived on the volume weightage, okay. Cross rate derived from the corresponding USD INR, etc. So from the exam point of view, FBL provide the reference rate, okay, and that reference rate is computed between 11 to 12:30 based on the volume weighted average. Again, this is not from exam perspective, so right now I am skipping. Settlement date and value date, very important from the exam point of view. Okay, suppose if there is a contract is purchased in future market, okay, so what is the settlement? So trade date, the date when both party agree to buy and sell, okay. Suppose example, one exporter importer may require, let's say, the 100,000 USD after 2 months, okay. So they have to repay the payment, they have to pay the payment what they imported from the foreign market goods or services. So they can enter into agreement with the bank or the other party, okay, at a fixed rate, example 85.50, 75, okay, where on this rate, okay, they will provide the 100,000 US dollar, okay. So this is the this can possible into the forward market as well as in the future market. So trade date, the date both party agree to buy or sell. Okay, today maybe trade date, settlement date, the after 2 months, the day when the actual currency transfer occurs, transaction process from exam perspective most important, cash transaction. Okay, like a small retail client come to the branch and ask for the $1,000. Okay, so settlement will happen same day because bank will take a money or debit their bank account in rupee terms and give the cash $1,000 or maybe issue the forex card having the $1,000. So cash transaction, it is the same trade settlement same day. Tomorrow transaction settlement day, next day T+1. So some high value transaction may not settle today, they may settle based on the next day. Spot transaction settlement on the second day T+2, subject to both center opens, adjustment are made if holiday. Forward contracts, any settlement beyond the spot date, okay, 1 month, 2 months, so again it is a T+2. So here from exam point of view, you need to remember cash transaction in forex, cash transaction settlement is same day. Tomorrow transaction T+1, spot T+2, and forward is also T+2 on maturity or expiry.
What's the difference between cash and spot here?
Yes, good question. So please understand when retail client come to the bank, bank have a ready money is available. Okay, maybe in limit of $1,000, $2,000, $5,000. So bank can issue the dollar same day in forex card or cash. But suppose some institutional client come, okay, and asking for 100,000 USD example to pay, okay, that they have to remit to the their foreign market example. So in that condition, okay, they decide the price today, but the transaction will happen, settlement will happen after 2 days. Okay, so it is a T+2. So in way,
okay. Okay. Forward is in a contract, right? Forward is in contract, and then same term is also contract which expires in 1 day.
No, T+2. Forward means that spot means suppose importer come to you today and asking for a spot rate because they have to settle the payment within the 2-3 days only. So bank will transfer the money on behalf of the importer to the foreign account, okay, in 2 working days. But in forward, what happened that I decide the price today, but I say that after 1 month you will transfer to the company. Okay, so that is called forward contract.
Understood. So where does the term comes here actually? I mean the TOM tomorrow. What do you call it as actually? Is it a contract or how does it work?
No. Again, I'm saying that it is all kind of different transaction level. So here, cash tomorrow and spot, you can say depend on the size of the currency. So as I said, retail, you can say T maybe up to $1,000, $5,000. Maybe for a beyond the limit, okay, they say that okay, we'll settle tomorrow. Okay, transaction so T+1 and spot rate. Mainly institutional, it is used spot rate. So you can say this 2-1 for the retail, okay, and spot and forward for the institutional investor, institutional users. Sometimes you ask for the any retail, suppose asking for a bigger amount. Suppose if I say that many college students are going USA, example, for study, and they have to remit the fee, let's say $25,000. So in that condition, example that they say that okay, we may not able to do it today, so settlement will be happen T+1. Okay, price is agreed, but the transfer will happen T+1.
सर यानी कोई कॉमन है प्रिंसिपल के मतलब इसका इतना ही होना है
क्या?
क्वेश्चन आ जाए करेंसी में सेटलमेंट कब होती है, तो उसका क्या
हाँ,
आंसर है?
तो मैं वही बोल रहा हूँ, आपको ऑप्शन दिया होगा ना, कैश दिया होगा, टुमारो दिया होगा, स्पॉट दिया होगा, फॉरवर्ड दिया
ठीक
होगा,
ठीक।
आपको इस हिसाब से आंसर लिखना है। तो ये इंफॉर्मेशन हो गई। ओके, तो यहाँ पे हम आगे बढ़ते हैं। इफ वी गो अहेड, सो नाउ नेक्स्ट इज द क्रॉस रेट। ओके, so many currency pairs are not directly quoted, and their rates are derived from underlying pair. The calculation involves appropriate multiplication or division using bid and offer prices. Here example is given Euro INR. Okay, suppose question says that key calculation, you have a data Euro USD. Okay, Euro USD. So Euro is the base currency, USD is a quote currency. 1.1125 bid and 1.1150 is your offer, and you have a USD INR. Okay, 75.64, 75.65. Now think that key you are going for a vacation, example, in Europe, example. Okay, and there is no direct quote is available. So in that condition, what happened that you need to buy first, convert this money into that USD, and then finally convert into the euro. Okay, so here buy euro and sell euro rate we have derived. So this is called cross rate. Okay, so how it is derived, if we just discuss quickly, now just give me 1 minute. Euro, first base is Euro USD. I am just writing here for understanding. Euro USD data. Uh, 1.1125, 1.1125 and 1.1150, and USD INR 75.64. Now you just see the difference is the here it is a base currency is euro and quote currency is USD. Here it is a base currency is USD and price is the quote is the INR. Now we want to convert the euro INR. Okay, so euro INR currency we want to convert. So what we need to do, basically we think that I am going to Europe for a vacation, okay, and I go to a bank. When I pay 75.65, okay, pay 75.65, I'll get the 1 USD. Now when I'll take 1 USD, okay, and I'll go to the another dealer, okay, he'll give me euro. Okay, so 1 USD, again it will sell at higher rate. Okay, so I'll buy the but I have a 1 USD, so I have to divide 1.1150. Okay, so when I convert 1 divided by 1.1150, so I'll get indirectly 0.8968. Okay, now again here euro is the base currency. Okay, so I get finally how much? 75.65 is equal to this much. So if I convert into 1, so divide 75.65 divided by 0.8968. So I got 84.35, which is the offer price. So this is my offer price. So I have explained in simplicity. Did you understood? I am thinking that I am buying a euro. Okay. So I convert first.
Repeat the same, sir. Repeat. Repeat the same, sir, please.
हाँ, मैं करता हूँ रिपीट। तो मैं आई जस्ट रिपीट वंस अगेन। इस बार मैं हिंदी में एक्सप्लेन करता हूँ। तो मैं ये कर रहा हूँ कि मैं सोच रहा हूँ कि मुझे इंडिया से यूरोप घूमने जाना है, और मुझे यूरो की करेंसी बाई करनी है, पर मेरे पास है नहीं डायरेक्ट पोर्ट। तो मैं डीलर के पास जाता हूँ, डीलर 1, ओके, जिसको मैं 75.65 दूंगा, तभी मुझे $1 देंगे, बिकॉज दे सेल डॉलर एट हायर रेट। नाउ आई गो टू अगेन सेकेंड डीलर, okay, and if I give 1 USD, okay, then again they will sell at higher rate, okay, that euro. But here I have 1 USD and rate is, I have to calculate, so how many euro I'll get, because one euro is equal to 1.150, so I divided 1 divided 1.15.
हेलो
So,
सर,
हाँ बोलिए।
ये मैं जरा इंटरप्ट करता हूँ। जो भी चीज अपन बेचते हैं तो वो हायर रेट पे जाती है,
हम्म
बेचते हैं वो लोअर रेट पे जाती है। तो आपने ये यूएसडी का जो यूरो किया, वो ये 1.125 में जाएगा ना, लोअर रेट पे जाएगा ना।
नहीं नहीं, मैंने तो बाई किया है ना। मैं यूरो, यहाँ पे मार्केट मेकर का रेट ये है कि आप यूरो सेल करते हैं, मुझे मार्केट मेकर को सेल करते तो 1.1125 देते हैं, ओके। बट वो तो यूरो जो है आप बाई करना चाह रहे हैं ना, तो बाई जब करेंगे तो वो सेल कर रहे हैं ना, ये उनका सेल रेट है मार्केट मेकर से। ये यूरो का बेस करेंसी का बाई रेट है और ये बेस करेंसी का सेल रेट है,
ओके।
ठीक है। तो इसलिए हमने क्या किया कि हमारे पास जो है 1 USD है, तो हमें कम मिलेगा। कितना कम मिलेगा? तो हमने 1 से 1 डिवाइडेड बाई 1.15 किया, तो 0.896 आया। तो उसके बाद क्रॉस इक्वेशन किया हमने, तो हमें फाइनली जो है 1 यूरो के लिए कितना देना पड़ेगा, तो 75.65 डिवाइड बाई 0.8968, तो ये हमारा रेट आ गया 84.35। ऐसे ही हम उल्टा करते हैं कि भाई हम यूरोप से इंडिया घूमने आ रहे हैं, कोई यूरोपियन सिटीजन इंडिया घूमने आ रहा है, ओके, इफ समवन यूरोपियन सिटीजन इज कमिंग टू इंडिया एंड दे वांट टू बाय इंडियन रुपीज बट देयर इज नो डायरेक्ट पोर्ट, तो उनको इंडियन रुपीज के लिए क्या करना पड़ता है? तो व्हेन एग्जैक्टली यू डू इट सेम थिंग, you will get the rate 18.15. So it means that cross it shows that the market maker will buy euro at this rate and market maker will sell euro. Base currency is always buy and base currency is always sell. So this is a cross rate we have calculated. So I request once you do post training practice tomorrow, it will give more clarity. Right now we have limited time, so I'm not doing for the buy rate. Bid price. Using the correct convention path and selecting the proper bid offer spread ensure accurate cross rate computation. Similar logic can be reverse derived underlying the rate from the known cross rate. Again, very important from exam point of view, impact of economic factor. Fundamental strength. Currency value reflect the underlying economic strength of our country over a long run. Similarly, how companies fundamental influence the stock price. So countries fundamental will influence the currency price. Countries fundamental is good or better than the our trading partner, then our currency will appreciate. But it is not better or worse than our trading partner, then our currency go down. Local versus global factor. Domestic factor, we know GDP growth, balance of payment, fiscal deficit, etc. Global factor like commodity prices, USD performance against the other currency, geopolitical event, and play the crucial role. Short-term driver. What is the short-term driver? This is all long-term. What is the short-term? Demand supply imbalances, liquidity condition, large USD inflow leading to temporary INR appreciation or maybe depreciation if outflow is there, can cause rapid, often transient currency movement. So it is RBI policy is to basically reduce the volatility. If there is a huge inflow or outflow is there, so basically RBI intervene and reduce the volatility. Again, important from the exam, GDP and IIP strong growth and robust industrial production generally support the currency appreciation. CPI and real interest rate, rising CPI signal inflation. If countered with the higher interest rate, it can boost a currency by attracting capital. So if there is a consumer price index, and if there is an inflation, okay, and there is no interest rate increase, if I just take one example for 2 minutes, okay, so I am just saying that country A has interest rate, we talk about GSEC only, where interest rate is, let's say 8%, GSEC rate is 8%, and we dissect GSEC rate into two parts. One is, let's say 6% is inflation and 2% is the real interest rate, okay, RORE we can call it, okay, real rate of return. Now in case inflation moved to 6%, okay, and there is no change in the GSEC rate, okay, because now ROR is reduced to 1%. So in that situation, what happened that key currency depreciate, yani ki Indian currency or maybe the country currency will depreciate. But in case if inflation is increased to 7%, but same time, okay, either real interest rate is kept same, okay, then there is no change. Or even inflation increased, but current real interest rate is increased, then inflow of capital from foreign market because of countries offering higher real interest rate. So currency may appreciate. Trade and current account, a narrowing trade deficit is positive. So whenever the export minus import, okay, either it is zero or positive, it is good for country, okay. But if it is negative, but reducing negative, minus 100 to let's say minus 50, again it is a positive. But if deficit is increasing, export minus import, okay, then it is a reduce, it weaken the currency. US data, non-farm payroll and retail sale. So in US, they measure every week and month about the non-farm payroll data. So how many people are getting formal employment in the economy and what is the retail sale. If it is increasing, okay, growing, then means strengthening of the USD. Central bank action, policy decision, rate adjustment and FX intervention guided the market expectation and influence the directional moves. Same like we have a product we discuss in equity derivative, same product is there in currency market, okay, like forwards, okay, OTC agreement to exchange currency on a future date at a fixed rate, customized term settled by delivery or cash, okay, it is between the two party. Futures, okay, standardized exchange traded forward with fixed lot size, expiry date, margin, mark to market settlement. We'll discuss tomorrow in detail. Options contract is also there. Contract gives the right but not obligation to buy or sell a currency at predefined rate for a premium. Swaps is there. Agreement to exchange cash flow include the FX swaps, spot and reverse leg currency swaps is also there. Okay, the same thing is we have already discussed. So right now we conclude the our basic. Okay, so if we have any question, let me, so we can understand cross bid and offer. Okay, repeat 84.33 generally how much bank currency kept with the bank. Okay, spot in derivative something so bit confused. Okay, so
does options available in OTC as well? Because it's first time that I'm seeing. All the time that we've been talking about OTC future, I mean options and futures being traded only in exchange.
Please understand, the more the complex requirement of the user, they will go with the OTC market because then only their customized requirement is fulfilled. Okay, so in FX market, there are a lot of complexities there compared to the equity. Okay, so they have both go for the option and OTC as well as exchange traded.
Oh, okay.
Equity is also there, but in India we have a less use. Okay, but product is available. May not necessarily it is available in Indian market.
Noted. Thank you.
Okay, so what I suggest, let first go through the post-training test, and when we solve the 20 questions, because here a lot of calculation questions are there, so we require more time. Okay, so what I'll do, I'll share you the post-training test first. Okay, and please note pre-training test and post-training test as a different questions. Okay, so make sure that you attend thoroughly post-training test, and then we'll solve together all 20 questions. I am confident that when we solve 20 questions, your doubts will be resolved. So when you copy and open this test, okay, so this will look like.
Sir, just a second.
So I have shared the SI post-training test. Okay. So I request let first attend the post-training test, and then we'll solve the 20 question at a time. We'll solve your queries. So I request right now it is 17:15. Take a 10-minute time. Read the each question twice. Okay, and read the options and submit the test. So let take a 10-minute time. 10 minutes. Time for post-training test. Again, I am sharing the link. Okay. And 17:25, we'll start together, solve this test. And at a time, we will take your queries. We'll discuss, Devanshi, your question we'll discuss after this. Link already I have shared. Okay, so right now, invest 10 minutes time to solve the post-training test, and then together we'll solve the 20 question, and last we'll solve your all queries. Okay. Right now you are not doing post-training test, so please do post-training test. Follow your coach in spirit. That is the first sign to get a success. Okay, last 4 minutes.
Hello, sir. Hello.
We'll discuss
Hello.
after test only.
Sir, after completion of test, I'm submitting, but it's not accepting, sir.
You just refresh the page.
Okay. It's coming to mail ID and it's stuck, sir.
I think there must be problem from your side because my side there is no solution. You
Yeah,
just
this is the first time, sir. Till now, every time whenever I'm writing, it's after submitting also it's accepting.
so I think there's some problem from your side. So that's the reason I'm saying you open link second time and do it.
Okay, sir. Thank you.
Okay, last 2 minutes. Okay, I request first we'll solve the all 20 question. Hopefully your query will be sorted out. If not sorted out, we'll formally close the session at 6 o'clock and we can continue for another 4-5 minutes for your query. So there is no need to worry. Okay, so let check the pre-training test. We got average 3.97. Okay, because you have a limited understanding about the currency market. Then you have attended the 1 hour 30-minute session and you can see the simply output from a 4 to 7. Okay, so it shows that key once you realize in pre-training test the topic is new for you. So when topic is new, it means difficult for you. So you ensure the attentive learning. Okay, and that attentive learning, when we had the same type of question 10 and you got the result is far better, which is almost from a group unsuccessful, okay, to a group successful. So that's the reason in any technical training, okay, pre-training and post-training is required to realize pre-training. Otherwise, chances that if someone asks in beginning of, we should not conduct the pre-training test, but pre-training test score gives clarity. Okay, I need to be a more attentive learning, and when you attend training and get better result in post training, you realize and you get confident. Yes, okay, there is a drastic improvement because of the new learning. Okay, so let's move into the solving the pre-training test first. Okay, the first post-training test. Okay, why I'm saying equity basic, it is already released. My mistake. So this is the 88 response. Pre-training test in the question. In summary, even here also same 7%. So there is no need to worry. So I'll just open the pre-training test. Just just give me 1 second only. Okay, so let's start. So right now 76 response is there, so it is a 6.7, 6.57. So even the entire group is successful. So let me just start with the my test only. So how does a higher than expected US non-farm payroll report typically affect the US dollar? So we have learned in the last couple of slides, okay, that when US non-farm data is strong, okay, means that formal employment is high, okay, it will strengthen the US dollar. So strengthen the dollar, it indicates the job growth and economic health, okay, because here it mentioned higher than expected. If it is expected only, then it will not any effect on US dollar, but it is a higher than expected. Word is very important. Non-farm US data is higher than expected. It was expecting 5% growth, but actual growth is become 6%. So economy is growing faster than they expected. So dollar will strengthen compared to the INR or euro. Computing, let me do calculation question last. Okay, so we have complete clarity. First theory question we'll do, and then I'll open the Word file and solve one by one all calculation question. So what does tomorrow cash and spot transaction in the forex market? So as we have learned, tomorrow T+1 cash T and spot is the T+2 transaction. If GBP USD move from 1.25 to 1.240, which statement is correct? So now base currency is GBP. 1 unit of GBP is equal to 1.25 US dollar. Okay, but after some time it is getting only 1.2450. So it is showing the weakness in the GBP or strengthening the USD. So GBP is weakened while USD is strengthened. Again, this is simple question, so I am doing a market maker quote USD INR 83.1525, which is a bid price. So they will buy US dollar at this price and they will sell US dollar at this price, offer price 83.1550. If corporate customer immediately sells USD 1 million, so they have a USD with them and they sell to the bank, how many INR they will receive? So what would be the USD buy rate? User sell and market maker buys. Okay, so answer is equal to 83 lakh 15,000. 83 lakh. What is the answer? I'm not getting 83 million. Okay, it is a 1 million. So 83 million 152 500. What is the primary advantage of using a vehicle currency? We have discussed the concept of vehicle currency, transaction currency, reserve currency. So vehicle currency basically reduces the need of the cross currency. Okay. So it reduces the number of exchange rate needed in a multilateral system by serving as an immediate, thereby enhancing the market liquidity and simplifying the operations. Which of the following base describes clean float? Clean float means free float. Which of the following base describe the clean float in the exchange market? The system where the exchange rate is fixed by central bank with minimum variation allowed, it is called fixed rate. Okay, a regime where the currency value is determined solely by market supply demand with direct government intervention. So it is a partly right, but it is with direct government involvement, that is wrong. Okay, so a regime where the currency value is determined solely by market supply and demand without government intervention, so that is called free float. Okay. Again, this simple question, so let me take it. If 1 unit of gold is valued 10,000 and the same time value at USD 120, what is the implied exchange rate between US dollar and the Indian rupee in the gold standard? So from here, let me use the Word file and I'll just simple question, but I'm pasting this question. Okay, so it says that key 1 unit of gold is equal to 10,000 INR is equal to 120 USD. Okay, so what is the rate for the implied exchange rate between USD and the Indian rupee? So indirectly, 120 USD is equal to 10,000 INR. So 1 USD is equal to, what will do, 10,000 divided by 120. So it is the 83.33 is the right answer. What is the primary responsibility of FBIL, Financial Benchmark India Private Limited, regarding the currency rate? So we discussed that FBIL provide the reference rate. Okay, FBIL compute and dissemination of reference rate for USD, INR, and the other major currencies. Again, okay, this is a simple question, so I'm not using, not pasting, using Euro USD and USD INR. What is the offer rate? Okay, let me do it for once again I'll explain. Okay, so data says this is the, and this is the, okay, and now we have to calculate the rate for the Euro INR. Okay, so now here Euro is the base currency, okay, and USD is the quote currency, and second USD is the base currency and INR is the quote currency, and now we have to calculate the Euro INR. So please understand कि if I do a multiplication, simple multiplication, okay, so this is called this into this, okay. So now you may think that so technically what happened that key when we do a multiplication, this is practically in division, okay, and this is a basically upper. So this USD will removed. So we'll get final answer Euro INR is equal to this. So in that condition, 1.3125 into this, we get the bid offer rate, and 1.3550 into 85.6550, we get the offer rate. So here answer is, this is for the offer rate and this is for the bid rate. One more question is remaining. Again, same repeated question we discussed. So computing Euro INR cross rate. Okay, same question we have already discussed. Okay, to save our time, I'll use the one answer sheet I have. Okay, so this is the same question is there. So I'm explaining to save our time. So question says that key, this is the Euro USD rate, this is the USD INR rate, and we have to calculate the Euro INR rate. Okay, bid determining the cost to buy 1 euro in INR. Okay, means we need to find the offer price. So when using the 1 euro INR, you follow the conversion path. So first we'll buy the USD using the INR. So use the offer price, because we have discussed when we buy the USD, we have to pay higher amount. So offer price we paid. Okay. And then second, again, we have to buy the euro from USD. Again, we have to use the offer price, okay, which we have to pay the higher price, okay. And then we use same multiplication, we got the same answer. So it is a repeated questions we got. Any question here from 10 questions? Can you send this detailed answer sheet also? So we'll upload in partner desk, okay. So right now I am constructing the question bank, and hopefully by next weekend we'll share the question bank with solution for the each important category wise or module wise, for first day basic, second day futures and forward. So we'll provide you by next weekend. Okay. What is different? What is the difference between last two question? What is difference between last two question? Last two questions. Here our objective is that we calculate the Euro INR offer rate. Okay, and here we have Euro INR data is available, okay, and we have calculated Just when I'll paste it so I can compare it. Just give me 1 second. I'll paste here. Only difference is the data. My otherwise concept is similar only. Okay, concept is similar. So practically speaking, the here we have to calculate the euro USD bid offers paid. We have USD INR. We have. Okay, data is different. Okay, and our objective is to calculate simple offer rate. So we use this into this and we calculate the offer rate. Okay, here our objective is to calculate offer rate only, but data is a little bit different. So accordingly, we use the data. Yes, I explained the longer way because it is. You might think that my explanation was lengthy because it is the chronology I explained. Otherwise, here also same answer can be possible. 1.1150 and 75.6 both is the data we use and we get the same answer. Okay.
Hello, sir.
Yes.
You will upload this answer sheet also, not that descriptive answer sheet also.
Yes. Yes. We'll upload in the partner desk by next weekend. Right now it is
Thank you, sir.
under construction. Okay, so now we'll quickly go to the first test. Let me first solve this test and then we'll share the result. Okay, what was the defining characteristics of the exchange rate established by Bretton Woods Agreement? So it's said very clearly US dollar was pegged to the gold and all other participating currency were pegged to the US dollar with narrow band till 1971. Okay. Which of the following accurately describe the exchange rate regime of Indian rupee?
The screen is not visible, sir. Your screen is not this.
Okay, just 1 minute. I'll just once again share in case missed out. Okay, so now it is visible.
Yes, sir. Yes, thank you.
Okay, thank you. So Bretton Woods system. Okay, Wood agreement. So this is we discussed. US dollar was pegged to the gold and other participating currency were pegged to the US dollar with narrow band. Which of the following accurately describe the exchange rate regime of the Indian rupee? Okay. Now, if you read this, you may confuse. Indian rupee operates de facto control exchange rate system commonly as a free float where Reserve Bank of India intervened to keep volatility low without detecting the fixed rate. So here only minor difference is there, and it's a wrong statement. It is not free float, but it is a managed float. So as I said earlier also, okay, when you read the all four options, you can simply basically rule out the two options like INR is allowed to float freely without central bank intervention. INR is pegged to dollar with fixed rate. You can rule out two options. Okay, and balance two option, there could be minor difference. Here it is mentioned free float, so that's the reason it is wrong, but it is not free float, but it's a managed float. Which of the following would classified as an exotic currency pair? So in exotic currency pair, we learn that when USD and emerging currency, okay, USD and emerging currency, okay, So here we learn the exotic pair, a measure with an emerging market currency is known as an exotic pair. So here the exotic pair is USD, Turkish New Lira. Which of the following correctly distinguish direct quote from indirect quote? So direct quote, we learn foreign currency is a base currency and domestic currency is a quote currency. So here this statement, direct quote, a foreign currency is a base currency, whereas the indirect quote, the domestic currency is the base currency. How USD INR reference rate computed by FBIL on each Mumbai business day? Okay, so volume weighted between 11 to 13. So by computing volume weighted average of transaction price from randomly selected 15 minutes window between 11:30 to 12:30. Okay. Which of the following correctly describes spot settlement value date in the forex transaction? Again, same question. It is described in the non-numerical or text form. So it is a T+2. Okay, so settlement occurs second business day after trade day, provided both settlement centers are open on the day. We'll do it last calculation. If a bank interbank market quote is 85.1250, 85.6675, what is the ask price and spread? So this is your ask price, and difference between this is called spread. Okay. Which statement best explain the relationship between the real interest rate and the value of domestic currency? So we discussed that higher the real interest rate, higher the currency. Okay. So here higher interest rate strengthen the domestic currency by attracting foreign investment and enhancing the return on debt instrument. So right now, practically, if I give you idea, the RBI has drastically reduced the repo rate in last 2-3 months from a 6.5 to 5.5. It means that foreign capital in a debt market instrument may not come because they find it a lower return, because practically in India, on average, Indian currency is depreciating average 4%, average I am saying. So in that condition, if real interest rate, if interest rate is example 5.5%, so after all transaction cost and the taxes, the return is close to zero. So the maybe chances that new capital may not come, as well as the in debt markets especially, as well as the if old capital is there, they are likely to move debt capital move to the other country where they find the higher interest rate. How does rising consumer price index generally influence country's currency, considering both short-term and long-term effects? So we discussed the consumer price index, inflation higher, the currency will weak. Okay. So in short term, rising CPI may strengthen the currency if triggered with the higher interest rate, but in the long term, persistent inflation may weaken the currency. So we cannot export the inflation and taxes. So the country where there is a high taxes and high inflation, so foreign currency will appreciate, or domestic currency will depreciate, because the inflation and taxes cannot be exported to the other country. So last question we'll discuss, and then we'll take it your queries you have. Question says, so computing JPY INR cross rate. Okay, so JPY is the base currency, INR is the quote currency. Okay, and in JPY it is for 100 JPY. So USD JPY, so USD is a base currency and JPY is the quote currency. Okay, and USD INR. So I'll make it simple. Okay, let me follow the little lengthy first from understanding. So again, using the buy side argument, cost to buy 100 GPY. So I want to buy 100 GPY, how much I have to pay? Okay, what is the computed cross rate? So practically I have to, when I say I want to buy a JPY, so it is means I have to calculate the offer rate. Now again, when I have to calculate offer rate, I have to think that I am going to vacation to Japan, and let's say I want example let's say ki 1 lakh example, just I'm writing JPY. Okay, so how I'll get? I have to sell the Indian currency. So if I say in simplicity, I don't have a direct quote, so first I'll sell, okay, Indian rupee, or I'll buy the US dollar, which rate 75.65. Okay, and then I'll go to this again here, and how many yen I'll get. Okay, so again I'll charge the more. Okay, so if I go for 75.65 and 1 USD, okay, so 1 USD if I'll pay, so his quote is into base currency. Okay, base currency is USD. So they will, I want to sell USD, and to sell the USD, market maker buy the USD at what rate? 115.08. So here 75.65 for dollar buy, and for Japanese yen buy, I'll get the, okay, 115.08 yen. So now what I'll do, 75.65 divided by, because my rate now I have to calculate is into JPY INR terms. So JPY is the first. So what I need to do 115.08 into 100. So when I do it, I'll get the rate for the 100 Japanese yen. How much I have to pay? 75.65 divided by 115.08, okay, into 100 is equal to 65.70. Round off, I'm doing 74. So this is the offer rate I'll have to pay. Any question here? Thank you, and concept very well explained. Gratitude. Okay, please share the screen. So right now, what I'll do, right now I'll share you the first PPT. What you need to do today is to go through the PPT. Other material is not required. Okay. First, I'll share the result to you. Okay, and then I'll discuss. So I'm sharing you. So I shared the pre-training score. Okay, as well as I'm sharing you post-training score. Okay, so score you can go through after 6 o'clock. First, I am sharing you PPT. Okay, so I request. So this PPT you can download right now. Tomorrow session will be same time. Okay, session will be same time 2 p.m. onwards. So looking forward, all of you. You have my email ID. I am giving you once again. Okay. Or you can, in case if you have query, definitely during, you may not have any query, but in case if you have any query, you can send me a WhatsApp. Okay. So I can reply you on WhatsApp. Maybe once training is completed, then you can use the
Sir,
yes, tell me.
yes, tell me. दो क्वेरी, आई
हाँ
हैव क्वेरीज.
हाँ.
OTC is the exchange for the forward contract.
I didn't understood. What is your question?
OTC करके कुछ वर्ड आता है.
Over the counter. Over the counter.
Over the counter.
Yes, OTC means over the counter exchange. It's like a physical exchange where you can go and get the physical currency. It's like for retail client, they go to a bank, okay, and exchange the currency. But for institutional client, they can go to the some physical platform or e-platform and exchange the currency in physical form. So I have already shared you a detail. Tomorrow syllabus, as we have discussed, if you are aware, we have started with the basic. Tomorrow we'll go to into the, if possible, you can use a microphone, clear voice. There is some distortion.
सर स्वैप ट्रांजैक्शन का एक एग्जांपल.
हाँ, शाह गलत है तो आप चेंज करिए ईमेल आईडी में. एक सेकंड, लेट मी जस्ट कंक्लूड दी सेशन. मैंने student keyurkumar.shah@prudentcorporate.com, as well as I am once again writing my email mobile number, so you can send me the detail. Okay, in case of your query you can connect me through email or WhatsApp. Okay, so किसी ने पूछा कि कल क्या होगा, तो as I said that कि today we started with basic, tomorrow we'll do a futures and forward. Okay, you can follow the PPT. PPT contains the all training content for 5 days. So in case if you are completing day 1, you can go through the day 2 in the ascending format. Okay. So in case if anyone do not have a query, they can leave in case if you want to leave. Okay, thank you very much for your participation, attending training online with you can say attentive learning, participating in the pre-training test and post-training test. And as a group, we have successfully cleared both pre-training in both the category equity derivatives basic. All of you have average scored the 6 and above, as well as second difficult currency derivative. The initial result was discouraging, but it is the eye opener for everyone. Yes, we need to do attentive learning. Okay, and then as a group we have scored 6.5. So thank you very much. It is my pleasure to help you out. So that's exactly we have created the internal system to ensure that our partners are well equipped with the advanced product like PMS, SIF, AIF with qualitative learning. Okay, and they are able to build the good quantity and qualitative AUM for the alternate product, because the future is equally important, both mutual fund mainstream for retail client and those who are the upper middle class and HNI client. They will like to diversify their investment into the advanced product like SIF, PMS and AIF. So thank you very much. Now, in case if you have any specific query, one can unmute the mic and speak 1 or 2 minutes. We can discuss.
सर ये SIF में जो 10 लाख रुपए की मिनिमम टिकट साइज है, तो उसमें पूरा का पूरा इन्वेस्टमेंट फ्यूचर ऑप्शन करेंसी और उसमें ही होगा या 25% होगा उसमें?
हमने स्टार्टिंग में डिस्कस किया कि सेबी सर्कुलर ये कह रहा है कि आप इक्विटी में जो है वो आप इन्वेस्ट करेंगे 100 रुपीज एग्जाम्पल, बट सामने एडिशनल 25 रुपीज का आप शॉर्ट सेल पोजीशन ले सकते हैं. इसका मतलब प्रैक्टिकली हम ऐसा कह सकते हैं कि आपकी एसेट 100 की है, ओके, और 25 एक्स्ट्रा आप क्या ले रहे हैं, शॉर्ट सेलिंग पोजीशन ले रहे हैं. आपको लगता है कि कोई स्टॉक ओवरवैल्यूड है या कोई इंडेक्स ओवरवैल्यूड है, तो यहाँ पे विदाउट होल्डिंग दैट एसेट आप उसकी शॉर्ट पोजीशन ले सकते हैं. इसीलिए इसको हम कहते हैं लॉन्ग शॉर्ट पोजीशन, जिसकी टोटल हम कह सकते हैं एक्सपोजर 125 तक हो गया.
ओके, तो अपने एग्जाम के पॉइंट ऑफ व्यू से हम खाली अभी फ्यूचर ऑप्शन और वही हम स्टडी कर रहे हैं, तो बाकी का जो है जैसे इक्विटी, बेसिक इक्विटी, तो बेसिक इक्विटी रिलेटेड एनीथिंग विल बी अपीयर इन दिस कोर्स, क्योंकि जो बाकी की जो 25% पोजीशन है, अभी हम तो आई थिंक पूरा वही स्टडी कर रहे हैं
तो
फ्यूचर।
एग्जाम देखो, म्यूचुअल फंड डिस्ट्रीब्यूटर जो है उनको तो म्यूचुअल फंड का एग्जाम किया है ना, तो ये सेकेंडरी एग्जाम है। तो कोई व्यक्ति आज एसआईएफ एग्जाम करके एसआईएफ नहीं बेच सकता है, वो पहले एमएफडी होना चाहिए, यानी कि एमएफ का भी क्लियर होना चाहिए, एज वेल एज आपका सेकंड एसआईएफ का भी क्लियर होना चाहिए, तो तभी जाके आप एसआईएफ प्रोडक्ट करेंगे ना। इट इज एडिशनल एग्जाम ओवर एंड अबव योर एमएफ एग्जामिनेशन। तो एनआईएसएम 5 फॉर म्यूचुअल फंड डिस्ट्रीब्यूशन एंड एसआईएफ फॉर दी दिस वन।
सर
हाँ बोलिए।
स्वैप का एक एग्जांपल दीजिए, और दूसरा क्वेश्चन ये था कि एसआईएफ में डेरिवेटिव्स में ओनली इक्विटी अलाउड है या ये करेंसी भी अलाउड है, कमोडिटी भी अलाउड है, एसआईएफ एज अ प्रोडक्ट?
हाँ, तो सेकंड क्वेश्चन से स्टार्ट करूँ, तो जब प्रोडक्ट्स हमारे पास आएंगे तभी और क्लैरिटी आएगी, क्योंकि अभी तो हम जो है सर्कुलर जो आया है उसके बेसिस पे कॉन्सेप्ट की बात कर रहे हैं। ओके, तो प्रोडक्ट आने दीजिए, तक वेट करना होगा। और स्वैप का मैंने बताया इस हिसाब से कि वो एक ओटीसी डेरिवेटिव है, जहाँ पे मेन हमारा ऑब्जेक्टिव रहता है कि कोई एक इंस्टीट्यूशनल इन्वेस्टर अपना फिक्स इंटरेस्ट प्रोडक्ट, फिक्स इंटरेस्ट वाला उसके पास जो है बॉन्ड, उसको कन्वर्ट करना चाहता है फ्लोटिंग इंटरेस्ट वाले बॉन्ड में, तो वो क्या कर सकता है, उसको पूरा बॉन्ड बेचने की जरूरत नहीं है और नया बॉन्ड बाय करने की जरूरत नहीं है। वो क्या कर सकता है, अपने फिक्स रेट बॉन्ड वाले को फ्लोटिंग रेट में कन्वर्ट करना है, तो वो प्रैक्टिकली एक स्वैप ले लेता है मार्केट से, जो उसको फिक्स इंटरेस्ट वो देगा अपना जो रिसीव होगा वो बॉन्ड से, और सामने जो फ्लोटिंग इंटरेस्ट जो है वो ले लेगा। तो इट इज कॉल्ड स्वैप, वेयर सीरीज ऑफ कैश फ्लो ऑफ इंटरेस्ट रेट और मे बी करेंसी एक्सचेंज, जहाँ पे एक करेंसी में दूंगा किसी को और हर महीने एक करेंसी को ले लूंगा। जैसे कोई इंपोर्टर को हर महीने 1 मिलियन यूएसडी की जरूरत रहती है, तो कोई बैंक के साथ टाई अप कर सकता है कि मुझे पूरे साल का आप फिक्स रेट दे दो, ओके, यूएसडी का, और हर महीने में $1 मिलियन आपसे लूंगा ये फिक्स रेट पे फॉर नेक्स्ट 12 मंथ। तो इट इज अ स्वैप वेयर बैंक इज एग्रीड टू गिव अ फिक्स रेट ऑफ यूएस डॉलर फॉर नेक्स्ट 12 मंथ, ओके, एवरी मंथ $1 मिलियन। तो एक बार करते हैं तो हम फॉरवर्ड करते हैं, पर यहाँ पे एक ही कॉन्ट्रैक्ट में 12 बार पे आउट हो रहा है कि भाई $1 मिलियन जो है देंगे, लेट्स से 85.50 की प्राइस पे। तो ये सीरीज ऑफ ट्रांजेक्शन हो गए, उसको हम फॉरवर्ड स्वैप कहते हैं।
तो ये ओनली करेंसी में है या
सब में हो सकता है, इंटरेस्ट रेट में भी हो सकता है, इक्विटी में भी हो सकता है। तो हम जो है आगे एग्जाम्पल जब आएंगे तो डिस्कस कर लेंगे, ठीक है।
any kind of swap?
यस यस, आई रिक्वेस्ट एवरीवन, ये जो आप पीपीटी डाउनलोड कर लीजिए, जैसे हम मीटिंग क्लोज करेंगे, ओके, तो ये आप डाउनलोड नहीं कर सकते हैं। ओके, तो अभी आप डाउनलोड कर लीजिए, एंड कुछ क्वेरीज है तो स्पेसिफिक आप मुझे 1-to-1 ईमेल या व्हाट्सएप पे कर सकते हैं। तो यहाँ पे हम अभी मीटिंग को क्लोज करते हैं। थैंक यू वेरी मच एंड सी यू ऑल ऑफ यू टुमारो आफ्टरनून 2 PM। थैंक यू वेरी मच।